Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan. Take you through the rest of this hour, 55 minutes until the futures market closes on the day. And what a day it was. We find out that the tariffs in place against China are not 125%. They're actually 145%. And naturally, the market doesn't like that. Commerce Secretary Howard Lutnick's talking about exploding the U.S. economy today. Very interesting choice of words. And so markets really don't have a great time of it. The NASDAQ was down 7% earlier. It was almost in that lock limit territory. It does climb off those lows. It's off by 3.82%. Same thing for the S&P 500, which was down nearly 6 earlier, off by 3.29 right now after hours. Ilya, I think we should just start off with the fact that the market seemed to wake up and smell the coffee. At the end of yesterday's show, I posed the very direct question that everyone here was asking. Does this say buy the rip or sell the dip? The effective tariff rate against the United States, rather the United States is imposing against the rest of the world, would actually be higher than it was when we woke up on Liberation Day last week.
Mm-hmm.
Is the economic reality of disgust, as one Mr. Radigan might say, is that setting in here in this session?
Well, I mean, I think you certainly, as we talked about yesterday, and when you asked that question, I think we were sort of, I know I was tilting to sell the rip, and so I did today. But it's only right, it seems to me, because what did we learn yesterday? I mean, yes, we did get some positivity in the sense that we got to see market discipline appear to work on the administration. That was new, and the markets liked it. That makes sense. But did we resolve what was the essence of the issue? The essence of the issue since late February has been not the tariffs per se, not that the idea that there will be tariffs, I should say, but how the tariffs will happen and how fiscal policy is happening more generally. And once we saw the markets view clearly the negative impact, the dampening impact of these rollouts, be it the tariffs or other elements of fiscal policy, the immigration piece, the DOGE piece, that it's starting to hurt business and consumer confidence, that's where the market said, okay, well, this is bad for growth. Okay, well, we're going down. What does yesterday's reprieve do to change that? Absolutely nothing. We got an announcement that was like, oh, the tariffs were going to go in today, but the bond market seems to be getting unglued, so never mind. Is that anything more certain for markets? No. Is there anything there that businesses and consumers can better extrapolate now that there's a 90-day timer on these reciprocal tariffs, but we've still gone from, let's say, an average tariff in the single digits on the European Union to one in double digits anyway? Does that make anybody feel better or more certain? Is the economic impact any better? No. And so it seemed like there was room after yesterday's kind of exuberance at watching market discipline in action and cheering on the bond vigilantes for getting it done. It seemed like everybody looked back and said, well, wait, but why were we selling off in the first place? Is that thing fixed? No. Okay. And the CPI numbers certainly didn't suggest anything was fixed.
I don't think the tariffs are the issue.
Right.
I
think they are the case in point that everybody is looking at as an illustration of what is a larger thing.
And the illustration is incompetence.
Yeah.
It's one thing to be an incompetence while being the administrator of the most powerful organization in the world.
Well, and by the way, incompetence, not just to say there is no plan, that could be a version of incompetence, and some people are out there saying there is no plan, the president is just operating by the seat of his pants. He's just making decisions and there's no grand strategy. I mean, maybe that's the case, or maybe it's not. Maybe there is a grand strategy and this is part of the plan and this is what everybody intends to do. But whether it's this or that, we can clearly see that the rollout is not being greeted. So even if the plan is there, nobody likes it. And the stock market is showing it. So whether you want to call incompetence the idea or the idea's rollout, either way, the markets don't like it.
There is a slight rebound in the Fed cut odds here today, only marginally.
Yes.
We're back to about 3.5% by the end of the year. Inflation today, we had a report this morning that barely left an imprint on the market, although it does come in slightly weaker. We'll get there in a quick moment. Dylan, before we do, though, I want to focus
and
on
that inflation data pre-tariff anyway?
Yeah, and that's kind of why.
Yes.
Right. Why do you think this confidence is a problem? I've seen a number of articles today saying that the United States is behaving like an emerging market at this point in time. Is that really the case here, that the U.S. is no longer the bastion of stability and we just need to come to terms with that reality?
I mean, it's too early to say that. There's a lot of inertia. There's a lot of momentum. There's a lot of basis. There's a lot of basis for American primacy.
Yes.
Not just military primacy, but economic primacy and cultural primacy, technology primacy, all these things. And while this behavior is alarming and disturbing, I still am not of the belief. I think it's going too far to say the U.S. is obviously not an emerging market. To say that the current political leadership is behaving like a self-interested leader of a small republic could be a reasonable comment. And to say that the financial markets are exhibiting the sort of wild volatility that is more typical of an emerging market. I mean, the implied indictment of that statement, other than behavioral, is that the U.S. bonds and the U.S. currency are not as reliable and as stable as they have been in recent and distant history. I don't see how the U.S. bond is any less reliable today than it ever has been. I do see how the U.S. dollar is less desirable than it has been for the obvious reason. But it also feels like one of the objectives of the Trump administration is to make the dollar weaker.
It's a very interesting distinction here, because if there were a shunning of U.S. debt and a shunning of U.S. dollars, then there would be indeed a loss of confidence in sort of the veracity of the borrower, whether the U.S. is still a good credit or whether the markets still trust it to lend it money. And what we're seeing is, I mean, obviously we had a great auction this week. All of the selling has gone through smoothly, and the dollar seems to be weakening for cyclical reasons, because the markets anticipate recession and anticipate that there'll be easing. It's an interesting thing that happened with Fed funds futures today. They shaved a cut away. So we went from 134 basis points at the start of the week for this year and next back to 100, which is basically in line with the Fed's forecast. But all of it now comes this year.
Yes.
At least the markets are, or at least the markets are tilting that way.
4 of them through starting in June, ending in December. You have 4 cuts.
Ending in December, and then next year kind of erring on maybe not. Maybe we're done after that. So it seems like the market is kind of tilting toward we're going to have a recession, and that'll be rate cuts, and then we're going to be on the other side. And there's no reason to think that the world is ending. So this weakening of the dollar seems like a cyclical weakening rather than a death of the empire.
What do you mean when you say cyclical weakening?
Mm.
Well, interest rates go up and they go down. Recessions
I see.
happen.
You're saying
and
this is
booms
just
happen.
tracking. This is economic slowdown is coming, and U.S. rates are coming down. Dollars less valuable.
Can you before you get
yield
into it,
spreads are just shifting against
Right.
it.
As opposed to Banana Republic, get out.
Right.
Yield spreads, but U.S. Treasury yields are up today. The Swiss franc is up 3.5% versus the dollar. Gold is up by over 3%, 3.5% in today's session. This is a new
dollar got cooked today.
So, but stocks down, bonds down, currency down, gold soaring, Swiss franc soaring, Japanese yen soaring, euro soaring.
Mm-hmm. Yeah.
Why is that not? This is the market selling America. The globe is selling America and pulling money out of our markets.
I mean, I think when you look at what's going on along the curve, the way the curve has shifted sort of tells you one versus the other. I mean, the long end clearly seems to start to have this risk on, risk off component. We've been talking about this and the idea that when the source of the volatility is incoherence fiscally, or at least the appearance of incoherence fiscally, term premium in U.S. debt is going to rise. And we increasingly see, whether we look at the term premium estimate itself, that giant move down in bonds on Monday, that coincided with a massive jump in the term premium. It's not inflation expectations because break-evens are actually down. They're anticipating that the slowdown will give you net weaker inflation, not stronger, because of the severity of the downturn. They've kind of steadied over the past day or two. But since this whole madness began with Liberation Day last week, inflation expectations are actually down. Term premium, on the other hand, is surging. And so this feels like the market's demanding to be paid extra for duration because things are unhinged. But if you look at the front end of the curve, there's no panic. And the bond auctions, again, they went very smoothly this week. So it doesn't seem like what you're seeing is abandonment of U.S. assets. It's just a ton of uncertainty for obvious reasons.
One of the reasons that may have come down the pipeline today regarding the stability of U.S. assets, independence of the Federal Reserve at play.
Yeah.
There's a lawsuit making its way through the system right now. We talked about it briefly the other night with Victor, challenging what's known as Humphrey's executor. During the FDR administration, FDR tried to fire a Republican FTC commissioner. While the gentleman was suing the administration to get his job back, he died. So his estate carried on the lawsuit, and ultimately it was ruled that Humphrey was entitled to keep his job, that the president couldn't fire independent commissioners. And upon that lawsuit has rested the entire basis that there are independent ring-fenced organizations within the bureaucracy of government, like the Federal Reserve and the Federal Reserve Chair, that are insulated from the political whims of the system. They have terms that are set outside of the typical election cycle. They are appointed and confirmed. They're appointed by the president. They are confirmed by the Senate, and then they are left alone to do their job. So the administration is putting this on the plate now, where they are challenging Humphrey's executor, which, if the Supreme Court allows the administration to do so and fire these two FTC commissioners, which this lawsuit is based around, in theory, it opens the door for Trump to fire the Fed chair as well. Dylan, if Trump were to fire the Fed chair, we're going full Turkey, Erdogan style government here. Would that be the death knell for U.S. assets for the foreseeable future if the Federal Reserve loses its independence, as is now a very real possibility?
I mean, the only reason I say that no, it is not, is because the United States of America is too big to fail. And it's not just in the United States of America's interest to survive whatever Trump does. I would consider it 100% chance that Trump will fire the Fed chief or do anything else. There are no laws for these people, clearly. However, it is in China's interest, Europe's interest, Middle East, India. Everybody is ultimately long a functioning United States of America.
Yes.
And so, however wild and woolly the current administration's policies become, up to and including the firing of the central bank chief, which I consider to be 100% chance at this point. Maybe it takes 2 years. Maybe it's tomorrow. I don't know. But I don't think the lawsuit's even relevant. I don't think they care about laws, as laws are for normal people. But I do believe the United States of America is too big to fail. And so I do believe ultimately whatever happens over the next 3 years and 9 months will not have the ability to end the empire, as it were. I think that there's too much value and too much dependency and too much momentum in the underlying functioning of the cultural and economic system that is of value to everyone in the world in a way that makes saving the big banks look like chicken feed. So, I mean, this is the ultimate too big to fail, is the United States of America. That doesn't mean the dollar might not depreciate. I mean, how much has it gone down versus global? What's the average? What's the dollar depreciation look like? 10% or something over the last, couple week or two? So,
if you look since the beginning of the year, so just 2025 so far, you're looking at basically an 8.5% sell-off against the yen, 7.4 against the euro, 3.5 against the pound, and basically flat against the Aussie.
It's a 6.9% on DXY.
Yeah.
Anyway, the point is the dollar,
which is euro adjacent.
Yeah. I just feel like being short the dollar in some ways is one of the more
I loaded the boat again. I loaded the boat again this week.
Would you originate new short positions?
I would add if I see breakouts. I think the dollar might actually be a little bit done going down for a little bit here.
Just because it's so much so fast.
Just because it got shellacked so hard, and I think the euro might actually be at something of a resistance point here. I thought it was really interesting today that the market actually took down how many rate cuts are expected, as we were just discussing, even though the CPI numbers were weaker and the internals were weaker. So if you wanted to see the recession in hard data for the third month in a row, CPI actually shows it.
But to go back to your question, Chris, I don't know how this resolves, but I'm not willing to say that America is at risk.
Ultimately, I agree. I agree. American too big to fail.
Short-term confidence in American leadership is compromised, and confidence in American markets is compromised. However, I still strongly believe America is too big to fail. And
to your idea yesterday, which I think is a hugely powerful idea, if the Trump put is in bonds, which I think you're right.
We're going to learn that tonight. I have a feeling.
I think you're right. True. So, so first of all, we're coming down here, and that's probably a test. But if indeed there is a ruling on this thing from the Supreme Court that then sort of sets up the possibility, and the scuttlebutt in markets is already, if the Supreme Court allows this, then maybe this is a threat to Powell. That Supreme Court decision is going to tank the bond market as a test, and we're going to find out. And so far,
and then when he appoints Jim Cramer, the Fed chief.
Jim Cramer has been very, very hard on him.
Hold on a second.
He went on CNN with Aaron Burnett this week, and they sort of relived the famous rant a little bit. And he was very upset.
Well, whoever Trump appoints as the new Fed chief after he fires Powell is going to be somebody on television. Maybe Joe Kernan. Right. I think Joe Kernan says nice things about him.
I'm just thinking, how if you drop a cat, it lands on its feet, but if you drop a piece of toast, the butter side always lands down.
Always lands butter side down. That's right.
So if you strap a buttered toast to a cat, it just spins infinitely. It never hits the ground. if you put Jim Cramer in as the Fed chief and you're never supposed to fight the Fed, but you always fade Cramer, the market just explodes. Like you can't do anything.
This is like a Marvel Comics conundrum.
Yeah,
no, but to Ilya's point, I mean, it's like Pete Hegseth. Qualifications are irrelevant. Loyalty is the only test. So
then Larry Kudlow,
Joe Kernan.
Those are your new Fed chairs.
Somebody he watches on TV who's loyal. That's the only character.
Barney from
Scott
from Fox Business.
Kevin Warsh, like realistically, Kevin Warsh, the former Fed official. Maybe. That's probably it's again, and Scott Bessent. Right, like
whoever it is, they'll appoint a Fed chief who will just do whatever he tells them.
Well, this is the treasury market's complicated here because, as we've learned from what's publicly available reporting and from what I have heard within the industry, we're witnessing Japanese funds blowing up. Tweeted about this the other night. Charles Gasparino tweeted about it yesterday, and my tweet came before his. So just be clear. So the public reporting comes after.
That's not a candidate, by the way.
Charles Gasparino could be your Fed chair.
For you, by the way.
You have these Japanese funds that have been basically trying to just bootstrap up this arbitrage trade, which is your long cash bonds, you're short the futures. The basis is the difference between the two, less transaction costs. And if you ride that to expiry, you're guaranteed to make the difference in the contract every time. So you lever that up. In a normal functioning markets, it's free money if you have the balance sheet to do it. But when you're trying to raise cash, you sell everything. It's what we saw in gold earlier this week, where gold was selling off because you're just trying to raise cash. Okay. In the treasury market, this may be leading to a little bit of dysfunction. Swap rates have moved out to blown out to levels that we haven't seen outside of crises in the 2020 COVID episode in March 2020, and in long-term capital management's blow up in 1998. That is a prime source of concern that could ultimately draw the Fed into the market to do something like a liquidity facility to ensure that the underlying system continues to operate. But we're seeing that Japanese traders are selling off treasuries right now to cover losses, and they're repatriating it into the yen, not into Japanese stocks themselves. So the yen here is at 0070 now, Ilya.
Yeah.
Intervention's obviously off the table.
I started buying yesterday.
Okay, yeah. How much further do we have to go here?
I started buying yen yesterday. It started to roll over and push back sort of off the bottom of its range back into the middle. But now we're basically at the top of the range that's held since essentially the beginning of this month, which I guess is not even that long ago. But basically for the past week-ish or so, we've been in this range and we're back at its high. We're going to have to find out now because the risk reward seems a little bit shot to originate. I get the sense that tomorrow's consumer confidence report might actually be significant here. If you look at an average of the president's approval ratings from Real Clear Politics, right, or anywhere else that does a good average, Real Clear is the one I look at, you can see that the president is becoming increasingly unpopular and that the wedge is widening. No shock there. Obviously, we've seen consumer confidence already deteriorate for several months. Obviously, we've seen the markets seizing up. So no shock there. That probably means that consumer confidence is going to be weaker again, and that's the expectation. Mm-hmm. The larger question is, what happens to the one-year inflation outlook? Last time it jumped to 5%, which is basically back to the peak from 2022, but for some rounding. I think the ultimate peak was 5.4 or something like this. Mm-hmm. So the question really is, we know that observed inflation weakened. We know that inflation expectations are driven by this tariff mishigas. So if we look month to month, did that thing get worse meaningfully? Are we looking at observed inflation that's like what it was in 2022 2022? No. So maybe we will, but we certainly don't. And so it's all sentiment at this point. If that number doesn't move too far away, you could get a situation where you start to believe that maybe the Fed isn't riding to the rescue. At least not soon. And that could give you a dollar bounce. It might stress the bond market. We'll see if it actually twists the curve, where long rates start to come in a little while the front comes down. We'll see if that's what happens. But the dollar might strengthen a little bit, and stocks might actually weaken some more into all of this, because it seems like the recession is now observable. But maybe the Fed isn't prepared to do something with it sort of immediately.
I mean, Dylan, that is what the CPI report tells us today. If you scroll through the individual components of it, the areas that showed the fastest rates of disinflation or outright deflation, hotels, airfares, rental cars.
You see it. Right? It's core services. The weakening is in core services. That's growth. That's where growth lives. Everything else is nothing. Goods inflation hasn't had a demand impetus in, what, like a year and a half?
No.
It's all services. And services now have the weakest contribution to overall inflation, even though it's the biggest contribution. It's also had the biggest slide, down 24 percentage points from the prior reading. And it's also the weakest overall uplift since December 2021. If services is the only thing that was growing, and now it's the weakest CPI contribution in basically 3-ish years, the economy is weakening. It's very obvious to see.
Well, Dylan, here's the good news for the viewers of Overtime. If you're looking for what's been getting cheaper in the inflation report for food, fresh vegetables, 12.1% cheaper. Pasta, 10.7% cheaper. Being Italian American's never been so easy in America, Dylan. The bad news, the 3-month annualized percentage change for eggs, still over 230%, which feels like a personal attack.
That hurts me directly. I am displeased just on a personal level.
Otherwise, coffee's up 10%. That to me is one of the we're still tariffing all the countries that we import coffee from. What?
For no reason.
Why?
That stings, but not as bad as eggs.
We can't grow coffee here in the U.S. Why would we tariff it? Also, as a coffee person, that feels personal. So, but there's good news, right? There's some good news in here. If you're someone who,
but bread is down, lunch meats are down. It's not so bad.
No, anyway, but I think like the point is like that I'm not trying to be jocular at all. Like, if you look at how inflation's evolved over recent years, the cost of food at home is growing slower than the cost of food outside of the home. Okay, and so if you are a home cook right now, that's the silver lining from the inflation report. The garbage of the inflation report, and I know it's a month-over-month decline, and we all want that relief. The reasons why it's declining, the reason why Fed cut odds are going up, these are all bad reasons. The reasons that velocity of money is slowing within the economy and consumption trends are starting to fall. I brought that chart up from Michael McDonough. He's a very good follow over at Bloomberg. He runs their data services and produces all sorts of wonderful visuals that people can help make better decisions. By the way, I was looking on MarketWatch earlier. I got served with this incredible ad, which I felt like I needed to share. Volatility is temporary. Financial freedom is forever. That's a hell of a tagline to describe these markets. So we have gold here moving. We have silver here moving today. Obviously, good news for those of us that are engaged on the long side. Oil prices are back down here, Dylan. We're in a really funny zone. At these levels, it's not economical for companies to open up new wells. According to the Dallas Fed, that's between $67 and $71 a barrel. At these levels, it's not economical to shut down wells. That's about $50 a barrel. Is this just a proverbial purgatory for the energy sector for the foreseeable future, as we have this sort of Damocles of slower global growth looming around the corner?
Well, what it is it's an evidence of the sudden irrelevance of global conflict, and oil now trading as a direct indication of economic growth expectations and telling you we're in a recession and demand for energy is collapsing.
Ilya, do you have a slightly better perspective that's not so doom and gloom?
I mean, I'm still short oil. I got shorted before yesterday's rip. Yesterday's rip was unpleasant. I stayed with it, though, because it looked like it was a retracement within a down move, and it hadn't made any new headway. And indeed, we're back down today. I'm still a little bit upside down on it, but I'm basically back to scratch. If you look at a weekly chart, especially on the continuous contract, you can very clearly see the sort of cyclical dynamics here. We have taken out some very, very big levels here. And even if you sort of look at the absolute low on that range there, we're really chopping through a ton of technical wood here. And it seems like we've maybe taken out a level that is at this point sort of seismic importance, where we've cleared essentially everything that's been the range post reopening from COVID, when we kind of rebuilt demand. And now we're going to take it back apart because demand isn't there, because there's a recession. And so I'm looking for weakness here. I'm looking to see this extend lower, maybe significantly so.
I saw a great chart a while back. I just found it again. Josh Young, who I think is the CEO of Bison Interests on Twitter.
Yes, demanded destruction. Yes, that's yes.
So like when you get
those were the words I was looking for.
When you look at the price of Brent, so this isn't crude, but when Brent oil gets too high, and you could see when, how often are prices trading in these levels, the frequency of trading days at these closes, you could see when you're up here in the chart, we tend to cluster, and we tend to cluster right around where current prices are. But as you slide lower in the market, you disincentivize any further production. And that's why you don't spend much trading. You don't spend that many trading days down here, because when you start to see oil prices go into this zone, production comes offline, and the less supply you have, the prices then go back up. So we're sliding down the supply destruction part of the curve right now, where we're not quite in the zone where wells shut down, but we're almost there, and we were there much earlier this week. And just understanding that we historically do not get this low, because there is a natural economic mechanism that kicks into place to keep the market afloat, I think is a very significant feature, at least in the very short term, where if we get another shot down near 50, us staying down there, unless you really think we're heading into depression, you're probably going to get a bounce or some sort of floor.
At least you can sell the put spreads.
Yeah, right now is difficult. I was sizing up the trades earlier today. You have to lay out like 1 to make 9, and that's not the kind of risk reward I'm interested in. Even if you go out to 35 days here, and we wanted to just do a $1 wide put spread around 50, 51, 83% probability of profit, but risking 870 to make 130, no thanks. Not a 6.5 or 7 to 1 type of trade I want to take. So giving it some time to breathe to the downside a little bit, I think, becomes prudent. I hate to say that we have floors to work with, but at least upon first blush, it seems reasonable that, if the administration wants energy dominance, as we've seen from the Dallas Fed energy survey a few weeks back, executives are saying that if we get down to 50, we're shutting down production, we're firing people. We're not going to have energy dominance, independent energy dominance, if we get to those levels. So maybe the administration comes out and announces an SPR refill program. We know Biden did that. Biden was a very, very successful energy trader in his 4 years as president. President Trump could be one too. And starting to refill the SPR down here just like Biden did when you got into the low 60s. It means that we're replacing oil in the SPR at a lower cost than when we sold it back to the market at. That's a really good trade for the American taxpayer long term. And so an announcement of like that sort as we get down here is one of those things that we should be looking out for. Obviously, you want to have a position in place before that occurs. So if this equity market pain continues, right, if this dollar sell-off continues, concerns about global trade are swirling, you're going to get, likely in my eyes, more weakness in oil. It's weakness to fade because it could be another one of those tap out points. The administration doesn't want to see wells shut down as a result of their efforts. That's the exact stated diametric opposite of what they're trying to achieve here, as they've repeatedly mentioned. Dylan, is this a crazy idea to think in those terms?
You mean you're saying to buy oil?
To buy oil if it slides another $5.
No, I think it's a good idea. I think it's a very reasonable idea. I think it's the interesting thing about that is it's sort of you have two things here. I think that ultimately the market has more downside risk still than upside overall as a result of the whole Trumpistan vibes. However, there's obviously lots of relief rallies embedded in whatever is going to happen over the next few months. And the nice thing with the oil long position, especially if it gets a little more beat up, but even now, is that it gets you along the relief rallies and, long not the depression, like long some level of optimism relative to economic growth. So I like it in the sense that if you're looking for a way to be protected for some sort of less pessimistic interpretation of the world, oil's a likely place where you would see it. So I don't think it's crazy at all.
There's also the sense that if oil slides too far, too fast and stays down there, then U.S. production shuts down. The countries that we compete with to have global share of oil tend to be authoritarian regimes. And right. the tolerance there for pain tends to be a little bit longer than ours because there are really no political consequences for seeing revenues come into the government, right? Saudi Arabia, for example, they provide basically nothing to their citizens. So revenues up, revenues down just means less money in Mohammed bin Salman's pocket.
I mean, they certainly provide a whole lot of handouts to kind of keep the peace and make sure that there isn't some sort of a riotous situation. But your point is well taken. There is a lot more of a pain threshold, it seems, here than there is in those places, because if nothing else, those places can crack down in a way that we haven't and hopefully never will.
The natural gas trade, likewise, we are flooded in the market with natural gas right now, erecting trade barriers. Yesterday looked like they were coming down. We get some more of the details later in the session overnight. The market quickly does the scratch math that we did here on Overtime yesterday, talking about the new higher effective tariff rates, and we realize that demand for American goods is likewise going to fall. Natural gas off by 8% today. There's a lovely video floating around online right now of a gentleman wearing a $57,000 Rolex, admitting to the camera that he just lost his clients $150 million selling premium in natural gas. If you want to feel less bad about your performance over the past few sessions, I'd go encourage you to seek that one out. Likewise, just a messaging and PR. If you're going to do the whole South Park BP oil executive I'm sorry routine, don't wear a $57,000 Rolex while you do it. More tips on crisis management come to Overtime Monday through Thursday. Outside of energy, outside of commodities here, we've talked bonds. Ilya, we did this Monday during the sell-off. If there's something that you'd like to buy during the dip, what would it be? You said IXUS. You posted an article today talking about the British pound.
Yeah.
For the sake of ending the show here with some positive trade ideas, let's round out the horn here and let's round out the week. If we're going to go bargain shopping here and we're willing to ride out some pain as the market deals with the repricing of a new global trade order, what do you like in the short term? What do you like in the long term? And then Dylan, after Ilya, I'll go to you.
I still like being short dollars in particular against currencies that aren't the euro, because I think the euro is run The Canadian dollar is run, the Australian dollar is run, but the pound maybe still has some room. I'm already long, but I've held on to it, and I think it's got some space. In the equity indexes, if you're concerned about recession, as I think the markets are, then it makes sense to look at the Russell, because whereas the S&P and the NASDAQ held today, if you look at the intraday range on the Russell, it did not. It actually slipped back sort of in a way adjacent to what we see in the yen, where it's still in the range, but it's slipped into the lower half, and there was a little bit of follow through on it. So there was some scope to get a little short, and I did. Then probably the biggest piece of all of this is the long end of the curve. If you have a strong opinion on maybe there's not a recession that's cataclysmic, but just regular, and sort of the moves in Fed funds futures today suggest it, especially in response to that CPI data, just a recession, not the end of the world, not another COVID type or '08 type collapse. If that's what we're looking at right now, then you could get the market going, okay, well, the Fed's not going to feel any urgency, but they will cut. It'll just be later and more prolonged, and the curve twists. And obviously, ZB is on massive discount. So if there is a Trump put, and if there is a regular recession, not anything Armageddon-like that the markets are setting up for, at least for now, then might be some bargains at the long end here.
I made a joke in the chat about how I'm a Maxwell guy, and I replaced the Starbucks that my wife keeps with Maxwell House. Apparently, that's not being well received. Dylan, what are the long-term things that you want to go bargain hunting for down here in this market?
I still like the Mag 7. I think the tech narrative is really unaltered by all this. Ultimately, I love Meta. I love Amazon. I don't know if I'm trading, but in terms of adding to an investment portfolio, the AI hasn't gone anywhere. And, Nvidia, what's Nvidia look like? I mean, it's got to be an abomination. So I just think that entire story is on sale, full stop. I like your oil trade. I like Ilya's short dollar. And I kind of would leave it at that. And then I would defer to Ilya on the bond. But I think short dollar, long crude, and long the Mag 7 are the three most appealing ideas to me right now.
I did see something.
Not in a hurry day to day right now, just because when I'm running a 4 to 7% intraday range on the largest, most liquid indexes on earth, and I'm up against an administration that can do whatever they want. Mm-hmm. I don't see a reason to go. It's like sticking your head inside of a lawnmower. The blade part, not the handle part.
That's fair. Yeah.
That's a key difference.
Just to be clear.
Just to be clear there. I see a question here. What are the indicators in the chart? This top panel here is slow stochastics. The middle one is MACD, two different ways of looking at momentum. The lower panel in the third is IVR, just so I can get the full purview of historical volatility as we make our way through the market. And on the platform itself, different moving averages, EMAs 5, 13, 21, and 34, just going up the Fibonacci scale. Nothing too fancy, just a function of what I've learned to use that makes me feel comfortable. And Ilya uses different ones, and as Dylan's learned to practice technical analysis, he's going to slap on what he wants there too. I mean, you have to find what fits your cadence, your personality, your trading style. I'm a momentum swing trader, so I like to look at momentum indicators. That's my particular cup of tea. We do have bank earnings coming up though tomorrow, guys, and that is a question here in the chat. Now that we know that Jamie Dimon, alongside other bond vigilantes, have come along to save the day, Dylan, is what Jamie Dimon has to say tomorrow? All that
matters is the conference guy. Our earnings are irrelevant, and all that matters is the conference call. What will leadership of the bank say about current events? is the only thing that matters. Nothing in all the data will be ignored. The world changed in the last week, not so much because of the tariffs, but because of the way that the tariffs were rolled out and the way that the rollout continues to be handled. And the fact that the bond market already called bullshit on the whole thing 2 days ago, and it might do it again tonight. The only thing that matters is the forward guidance and commentary, more than ever.
Ilya, before I get to you here real quick, another comment here about the SPR and a few people talking about the SPR in the chat. I would encourage people to just Google for themselves and a specific phrase. I'm not going to say do your own research necessarily, but if you look up DOE crude futures program, you'll see that last year before, now it's 2025. So in 2023, you have ultimately a Biden administration that allows for the buying of futures, crude futures in the market for the first time. So the administration can take future delivery. That's great news. You couldn't do that before. We've seen that more of these programs have been put in place, and this is now a tool that the Trump administration has. They can go out along the curve and they can look at the depressed futures prices to actually go into the market and solve this SPR problem. Ilya, tomorrow, rest of week, what are you thinking of that matters most? You don't really care about the earnings themselves. You care about the guidance, right?
That's right. I mean, the earnings themselves are whatever. I think the question is the guidance, of course. And I really want to see what the University of Michigan consumer confidence numbers do. Never mind what they say, what they do, and how what they do lines up with what they say and how the markets react. I think for the bank earnings, the likelihood that you get bombs thrown should also be moderated by the fact that there is no interest for any of these people speaking to create a run on their own institutions or to create turmoil in the credit space that they then have to deal with. So the chastising will be there, but it's probably going to be sort of optimistic chastising. Like everything is going to be fine. America is America, but we need to make these adjustments. Blah, blah, blah. It's all going to be very civil. And I don't think that we're going to learn anything from it, except that the banks don't like madness, which is not surprising. Who does? So I think when you ultimately land on it, if the message from the bankers is this is unpleasant and we don't like it and there's an economic downturn, but we need not get overly hyperbolic as long as there are some changes made, wink, wink, nudge, nudge. And then the consumer confidence numbers are bad. They're expected to be bad. But the inflation side of it sticks, doesn't necessarily fall back in because the chaos around speculating on tariffs hasn't changed at all. Last survey to this one. Then you end up with, I think, this is a regular recession. The Fed can't rush to cut, though. It'll be faster and sooner, but not that soon, not emergency, not hair on fire. Dollar has room to strengthen. Long end of the curve has room to strengthen. And then we'll see. I don't think stocks like it. Ultimately, I don't think risk likes it because I think risk ends up saying the entire reason we've been upset is the growth implication, and the growth implication hasn't been fixed. Anybody that's working on this on the administration side is only working on the sentiment and the optics. They're not actually changing anything. They're not changing the thing that makes this a growth scare.
No, they are not. They're not doing that right now. That is for sure. If only to just clear up some things that I think people are talking past each other in the chat. Just for points of clarification here. Yeah, Trump did say that the bond market was the point of stress for him. There's a lot of great reporting out there. People go read it, Politico, Fortune, Bloomberg, at how when the tariffs hit at 12:01 on Wednesday, Trump was looking at bond yields. and he was looking at the bond market. He wasn't looking at stock futures. He was looking at the bond market. And when yields kept going up, that caused him to reach his pain point here. In terms of Trump trying to say whether or not he was telling people it was a good time to buy his stock or the broader market, I'll leave that up to the viewer themselves. There is something that piques my interest when it does come to that. He sends out a lot of truth socials during the day, lots and lots of them. He doesn't sign them with DJT at the end. You can look at all of his comments here. Just out, inflation is down. No more sanctuary cities. Great news. DJT signed here, not here. He did put it in the tweet yesterday. It's a good time to buy. Now, I didn't see this as a, good time to buy DJT. I see it as him signing his name. He doesn't sign all of his comments. Make of that what you will. There's also the adage, Ilya, which, the man with his hands on the levers of the economy said it was a good time to buy, and obviously we didn't buy nearly enough. Worked for Obama in March 2009, worked for Trump in April 2025.
Mm-hmm.
As we wind up for a day, clearly more signs of de-escalation are needed. I am keeping my eyes on what happens in the bond market tonight, particularly as we make our way through the Asian Open. I think that we're going to see another test of the lows that are coming up here, and I think the market wants to see what comes of that. If we're hanging out near the lows in treasuries tomorrow and the administration doesn't say or do anything different, I think the treasury market's going to start screaming again. And I will be completely on the wrong side of the trade because I'm directionally neutral in notes right now and leaning long deltas in ZB after all this.
Yeah, me too.
And that would be wrong. That would be wrong.
I'm leaning long the long end still. I have it via those TLT call verticals, but I still have it. And it would be good to get some relief. Let's put it that way.
As we wind this down, Dylan, gold is going to close at 31.94 and change here. It's going to be a new all-time high on the close here for gold. Silver has some catching up to do, but it's up another 2.3% today, back of $31 an ounce. This week is almost over, but we're nowhere near out of the woods of the situation.
Not even.
No,
close.
I mean, I think that's why I said, there's originally, I said this when we were talking to Tom and Tony an hour ago. This started with terror and fear and shock with those first sell-offs. Then it's had its moments of relief, both intraday and then with the mega rally yesterday. And today felt like the first day that was met with a degree of boredom and disgust. Even though I know the move was massively lower, but it wasn't massively lower, and the emotional reaction was nothing like the emotional reaction from the massive down days of a few days ago. And so it'll be interesting to see because I feel like we're transitioning to a disgust and an expectation this will continue for weeks, if not months.
Well, and Chris, take a look at the 4-hour ES chart just for fun here. And take a look at where this thing stops. So just from a price action, kind of watching the tape perspective, you have a ripper of a rally yesterday. You pull back today. Where do you land? Squarely on previous resistance turned support inside the range. And that's the same thing that the NASDAQ looks like. I mean, this is as textbook of a retracement
which
as
tells
you
you
could possibly
what,
imagine.
What is that?
It tells you that they didn't do enough technical damage to tell you that the rally is doomed already. It tells you that it lost steam. It tells you that we are at a decision point here. We can either undo yesterday's breakout or not. I think if you look at Russell, though, it has undone this breakout. And I think that may be the most interesting thing of all. Not only did it undo that breakout, it also held on a retest of it. It didn't get back over. So the recession fears seem real. Small caps would get hurt the most if it were a sentiment situation that was steadying, but a growth situation that wasn't getting any better. You would expect kind of sentimenty names like NASDAQ to do better than growth sensitive names like Russell. And so all of this seems to kind of dovetail with what you're saying, Dylan. I think people are getting away from sort of, oh my God, hair on fire, to just, oh man, this recession is going to suck.
Yeah, there's a sense of malaise and acceptance that's setting in here. First it was denial, then anger, then bargaining. Now it's depression.
Yeah.
With that, overtime.
It's whiskey o'clock here for the financial markets.
Yeah, no, there's an IPA in the fridge right now that has my name on it. With that said, overtime is out of time for today. Not just today, but also this week. It's been a week. Not just this week, also last week. But, there are weeks where nothing happens and decades where a week happens. Or no, weeks where decades happens. Man, I could have stuck the landing. We're out of time here. We'll be back on Monday, same time, same place. Monday through Thursday, 4 p.m. Eastern, 3 Central, right after first call. Good luck trading, of course. After this, there's a brief break. Then Tasty at Night starts. Ilya Spivak's back with Macro Money. And then at 6 Eastern, 5 Central, Sosnoff and Jones, they're going to debate if this is the right tariff strategy. Stick around. Good luck.
So I studied economics and international relations, and I wanted to do the hands-on rather than the academic version of that, and the most natural thing was global macro investing. I begin with a sense of where I think the overall direction is for the macro theme for the next 6 to 12 months, and then look at some basic response from the price action to see how it's going. I think the price itself is the purest of indicator. It subsumes within it the collective emotions of the market. One of my favorite mottos, if you will, comes from the always great Ira Harris, who said, if you're right at the wrong time, you're wrong. And so for me, every macro narrative begins with what's the price action saying, rather than this or that economic indicator or some such thing.
If you missed the live show, here's our cherry on top weekly recap.
I had what do you call the hot girls dinner?
Oh, you had girl dinner.
Cheese plate?
No.
Popcorn and wine?
Crackers?
I went snorkeling.
You went snorkeling?
But I said the last time I went snorkeling.
And the fact that you've ever been snorkeling is pretty amazing.
That it also implies a future time that you will be snorkeling, right? Not because you didn't say the only time I went snorkeling. You said the last.
The last time. It kind of has the implication.
What did you say? The fact that I've ever been snorkeling is amazing?
Yeah.
Why?
Because she studies physics and it's not supposed to work.
It just doesn't, yeah.
Wait, you're going to Vegas?
I am going to Vegas, yeah.
Ooh, for what? For just funsies?
For my birthday.
Oh, wait, I didn't know it was your birthday this weekend?
Yeah.
Oh, happy birthday.
Yo.
I didn't know you were an Aries.
I am an Aries.
Yeah, that kind of tracks.
Something. What is your sign?
I'm an Aquarius.
Aquarius?
I'm Aquarius, yeah. Tom's a Pisces.
Pisces.
Yeah.
That makes a lot of sense.
It does. Yeah. It really does.
It kind of tracks.
I don't even know what that means. Sure. Whatever.
I think it means you like fish.
What happened, girl, during last call?
I lost my
You want to talk about it?
I lost my beret.
You didn't lose it.
I found it.
So you got...
I'm thinking of getting rid of it.
Oh, new look?
I'm thinking of the new look.
You should do a faux hawk.
Oh,
What is
I think you nailed it, Vanessa. I don't know.
No, cornrows.
I could see rocking some cornrows.
Yes, cornrows.
I think you should go to Flavortown and just get the Guy Fieri spikes.
Boom, platinum tips.
Platinum, yep.
Is it true? Did you skip the beret yesterday?
On the clothes.
Oh, it looked like it looked like a decrepit old grandmother. It was so gross.
It's like that old monster from Tales from the Crypt.
Get the full scoop by checking out the archives at tastylive.com.
I tend to call myself a lonely options trader because I really don't have a lot of people that I could share stories of wins and losses with. Like Tasty Live plays the whole day at my house. I love that they've made everything really easy to digest and take in. I love that you can easily send an email if you have any questions and Tom will be quick to respond to you, or if somebody else, Nick, Tony. I really enjoy that it's a customer focused and it's a customer centric system that you guys have here. And Tasty Live has definitely changed my life financially because I'm able to determine how and where I can make my gains and not be a passive investor where you're just relying on the markets to do something for you. You could actually go out there and do it yourself.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Well, that was short-lived. Stock markets had a ripper of a rally yesterday. In fact, the largest one-day move since the bounce from the COVID lows in late March of 2020. And today, it fizzles. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And as I was titling the upload of yesterday's episode of the show for YouTube, the question I posed in the title was, stocks surge, but is the move already over? And there was some feedback that came in. Some people thought, yeah, probably already over. Things are very bearish. And then some people were saying, well, isn't that a little bit too early to say, and isn't that a bit overly negative? We've just had this massive day. And indeed, it seems like, as it turns out, the steam has been lost. Now, it has been only one day. And so I think the question that we find ourselves with now is, okay, well, we've had a pullback. Is this truly the beginning of the next leg lower, or are we going to chop around here for a while and still find our way? And to help us make that determination, we actually have the last bit of macroeconomic data of substance looming here in the last hours of the trading week. And so we're going to unpack what's going on here in markets and see if we can't get a cleaner read on the swing that comes next. We'll start here with just the S&P 500 as a kind of benchmark. This is the weekly chart just to kind of anchor where we are. And we started the week saying this looked like the kind of spot here referencing the swing highs from 2022, resistance now becomes support. And sort of thinking about if the markets were going to bounce, this would be the place to do it. Sort of the textbook backfill that you might expect. You have a massive rally, you have a massive correction in that rally. If you were going to find a point where the sell-off loses steam, this would be the place to do it. And indeed, on Monday, that is exactly what happened. We found a little bit of a floor, and in fact, I was a buyer. I was selling puts into that move because it looked like indeed there was some level of exhaustion. The news flow hadn't become any better, but the market stopped falling, and that seemed to signal that maybe the stock of negativity had been priced in. Then, of course, the following move was a ripper of a rally, as we were saying earlier. This dramatic surge was, again, the most intense move since the first lurch higher off COVID lows back in late March 2020. But I ended up getting out of my long positions after most of it, I didn't quite catch all of it. It ended up being something like an almost 10% move. I caught about 7 and some change percent of it, because where we ended up landing, and we talked about this on the show yesterday, where we ended up landing was right at the underside of the range that we cracked on last week's Liberation Day tariff announcement. That's this gap right here. And so it looked like we'd hit something of a wall and maybe stood the risk of a correction lower. And we discussed on the show yesterday why that level might hold, and indeed today it has. We have a strong move off that level back down. Now, obviously, we don't do enough technical damage here to, let's say, slide back toward 5,000 or something like this. So this may yet have room to correct further, and we may chop around here for a while. Who's to say? But the idea that yesterday's surge was going to find follow-through seemed suspect, and indeed it hasn't found that follow-through. And ostensibly, it makes sense why. The announcement yesterday that the rollout of reciprocal tariffs would be softened, that there'd be a 90-day reprieve for countries on paying tariffs above the new 10% baseline for everyone but for China. We got some clarification today that China's new tariff rate is 145%, which, frankly, these numbers are getting so astronomical and so obviously bait for a negotiation that they might as well be a bajillion percent or something like this. But nevertheless, what that doesn't change is the reason that the markets started to sell off around sort of the broader rollout of the fiscal policy agenda. And that happened much earlier than all of this, needless to say, about mid-February. When it didn't happen was November, when the outlines were getting known, at least almost certainly. It was very clear that some amount of tariff increase would come at the latest in November when the outcome of the election became known, and clearly the markets didn't sell off on that. They sold off here, when the rollout of the agenda started to show up as severe deterioration in business confidence and consumer confidence numbers. And so what we see then with yesterday's announcement is a relief of the sentiment part of this. Obviously, that announcement in the Rose Garden last week did not imbue anybody with a sense of forecastability. What it showed was a foam board with bilateral tariff rates for a whole host of trading partners, setting up the stage for negotiation, but also telling businesses and consumers, you're not going to get certainty that you can extrapolate forward on our tariff policy until all of these negotiations are done. Successfully, unsuccessfully is hardly the point. That they are not done and that there will be more time elapsed means more time that you have to hold back capital because you don't know what your supply chains are going to look like because the tariff regime remains obfuscated in practice. And so when you get that, you, of course, get this panic sell-off. So the comments yesterday about the slower, kind of softer on-ramping reciprocal tariffs, that helpfully tells the market that the administration is not impervious to market discipline completely. There's a sentiment improvement there. It helpfully tells the market that the hit will not be as great right away. That seems to improve sentiment. But the forecastability and the predictability that makes this an economic headwind, that wasn't addressed. And so today, the markets kind of end up soggy because the upshot ends up being a sentiment flash in the pan improvement and not something more lasting. And we can see the economic hit very clearly here. As we've said on the show before, this Atlanta Fed GDP growth model is a nowcast, so it takes in economic data as it comes out, which can be multiple times a week or even every day, depending on the data's cadence. And it's not important where its absolute levels are, whether the economy is actually going to shrink at an annualized rate of 2 to 3% or not. The important thing here is the direction of travel, because what we can see is the tone of the data going into the model. And obviously, since the middle of February, that tone is decidedly dark. So the growth scare and the uncertainty behind it is really, once again, reasserting itself after yesterday's sort of sentiment window dressing. We got a CPI report that, interestingly, gave us weaker inflation than anticipated, 2.8% on the core. That's the first time we've seen anything like that since 2021. The headline number down 2.4% versus 2.6%. So certainly disinflation gaining more momentum here than was anticipated. But it's really the internals of this report that are the most interesting. If we take a look at which parts accounted for the drop, we can see that the meat of the decline is in core services and in energy. Now, this obviously, the Fed doesn't have much agency over, nor really does it have much agency over the price of food. Those are set in global markets. This is why we pay so much attention to the core. But it is notable here that energy is, of course, a very cyclical sort of thing. And we've seen crude oil fall with stock markets in anticipation that there is, in fact, a recession that's gathering steam. But the most shocking part of all of this is this bar right here. We can see the meat of the decline in inflation comes from deterioration in core services. And this is a much bigger deal, although this move in energy obviously looks like it's similarly sized because, of course, core services is by far where the growth is. We can see that of the headline number here, the headline 2.4% inflation rate, 2.25 percentage points was core services. Goods side of the ledger is a rounding error. Food is basically unchanged. Energy, basically a rounding error, a little bit more negative. And so what we find here really is that the part of the equation where all of the growth lives is the part that's doing the weakening. Moreover, if we consider what these numbers sort of actually look like in context, this contribution to overall growth at 2.25 percentage points, obviously we're implying growth by looking at the price impulse and saying when there is a pickup in demand, inflation tends to go up. When demand weakens, things go on discount and prices fall. Sort of think of it as the core services sector getting put into the bargain bin, as it were. That's what appears to be going on here. That 2.25 percentage point uplift is, first of all, marking the biggest disinflationary impulse of the bunch, as we just saw, but more importantly, the weakest contribution to the overall CPI number since December 2021. That suggests that if everything else here is weak and anemic, and especially the good side of the ledger is weak and anemic, what we're watching here is growth decelerating. The demand pull on inflation weakening. So whatever concern the markets have about recession seem to be getting some validation here. We mentioned over the past several days that even though the tariffs might be seen as inflationary, broadly speaking, and the Fed has asserted this and does make sense, that if you increase the sales tax on imports, which is really what you're doing with this increase in tariffs, then the end sticker price for whatever thing is going to be higher. And nevertheless, break-even inflation rates, the inflation expectations baked into the bond market, they've been falling since Liberation Day last week, as if to say that the recession caused by this will be so severe that the drop in demand will overwhelm any one-off or temporary adjustment in prices because of the tariff itself, and ultimately will be disinflationary because the demand drop with that severity will overpower for a net disinflationary impact, and not the good kind, the painful kind. This seems to validate that idea. Interestingly, against this same backdrop, the stock of interest rate cuts priced in for the Fed has actually eased back a little bit. We started the week at 137 basis points in the wake of last week's fireworks. We've shifted in here to just about 100 basis points, a little bit more. So we've basically shaved the equivalent of one cut from the outlook. We've gone from 5 to 4. But what's interesting is that there's a sense of urgency in markets. 84 basis points are on the menu for this year, 19 for next. That is to say, we're leaning in the direction of probably 4 this year, maybe none next year. So if you kind of round off the 84 to 100, you end up with the markets are biased towards seeing the stimulus quickly rather than later. And that, of course, is a bit of a clash, a little bit more sense of urgency from what we see in the Fed's own forecasting. We saw they just updated this in mid-March. It's 50 basis points for this year, down from 4.4 to 3.9, and then 50 basis points more next year, down to 3.4. So the total tally here is about the same at this point. To see that with the data that we just got from the inflation numbers seems to suggest that what the markets do is they see the recession, but what they don't see is some manner of looming collapse or crisis, perhaps echoing the improvement in sentiment that we have right here. That is to say, in showing that market discipline does work and the bond vigilantes are getting heard, more specifically, seems to have reduced some risk uplift in yields, as it were, and suggested that maybe the Fed does not need necessarily to go and do emergency cuts maybe as soon as May, that instead it's a recession around this uncertainty that we're looking at, as the markets were fearful of at the start of this whole thing in early mid-February, is more accurately timed. And what they see is then the Fed not really in a hurry, delivering ultimately a bunch of stimulus, perhaps toward the end of the year, in the second half, perhaps, but not really feeling like that they have to pull the emergency brake, as it were, on whatever volatility. And with that in mind, we get another piece on the story in consumer confidence, which of course has been a key driver of why the markets are so upset with this rollout and why they think it's starting to push the economy toward a recessionary state. This has been an early indicator of where the economic headwinds have come from, and we're going to get the latest update here. Not surprisingly, the expectation is that what the University of Michigan will report tomorrow is that sentiment continued to decelerate. That seems fairly easy to surmise and really shouldn't be market moving because it shouldn't really surprise anyone. We can see here from the polling aggregates that you can look at from different sources I like to look at the one from Real Clear Politics. It seems timely and well constructed. We can see here that the president's job approval has increasingly deteriorated basically since sort of mid-March going into April for obvious reasons. All of the tariff drama, of course, is front and center through this period, and we can see the gap is increasingly widening in the direction of disapproval. So it seems only right that if you then polled those same consumers and asked about their sentiment, they were going to be downbeat. The real interesting part here is this inflation expectation. We mentioned that so much of the driver of sentiment declining has been the idea that what these tariffs will do is revive inflation, make things more expensive, and in that action make consumers gloomier for obvious reasons. And we saw that the jump here in the one-year inflation outlook was all the way to 5%, just a hair from the highs in 2022. That, of course, was the peak in the post-COVID inflationary cycle. But the difference between now and then, as we can clearly see from looking at the inflation numbers here, back then, inflation was in the realm of 8% at the headline. But now it is very clearly not that. So whereas before the markets might be forgiven and consumers might be forgiven for extrapolating inflation forward because it was already high, here this seems more an expectation of a change in the reality that is currently observed, because clearly inflation now is about half of this forecast. Again, the most recent numbers here, 2.4%. So the key thing for markets here may well be whether this number starts to come in and starts to cool off a bit, or it doesn't. And I think we can probably surmise that just as sentiment here probably deteriorated again because of what we're seeing here and all the drama around it, this number, in that it's driven by sentiment and not by observed reality, is probably holding somewhere near the same levels, if not higher. If it is higher, then it's probably not higher by a lot, because indeed, people's reference point is a time when indeed the inflation really was much higher. But it's probably not falling off to any significant extent. And that might again dovetail with what we're seeing right here. That is, a Fed that isn't necessarily in a hurry to deliver emergency stimulus, but a Fed that is likely to need to wait a little bit at least, then deliver it once the growth hit becomes really obvious. The implications for the markets there are quite interesting, because on the one hand, the implication might be a longer on-ramp for cuts, and so the dollar might strengthen a bit off its dramatic lows hit today. But stock markets may be no happier, because what it would imply is that the recession that we've been worried about since mid-February will continue to build unchallenged, at least for now. And so the path of least resistance for risk, now that we've kind of gotten through the sentiment seesaw, might well be back in this direction, as the broader narrative, the longer term narrative, this more orderly narrative, becomes once again the path of least resistance. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. That makes this the last show of the week. Macro Money is, of course, back next week on the very same schedule. I will be on with Chris for Futures Power Hour tomorrow, as I am every Friday. Back with Victor Jones and Tom for First Call on Sunday. Back with Chris for Futures Power Hour Monday. On with Victor for The Price of Truth on Tuesday. Writing for the news and insights portion of tastylive.com. Commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Good luck out there. Macro Money's back next week.
It was a great show, very inspirational and motivating.
I feel like you got to know each of the traders a lot better on a personal level. It was awesome.
This is my 10th or 11th live event. I thought the math would be really complicated and it wasn't, and then it just made sense.
They've opened my eyes to many different strategies.
And I realized there's a reasoning and strategic planning that you could do to be successful. I love all you guys.
Having trouble understanding what your trader buddies are saying? Here is what they mean when they say slippage. Every business has costs. Slippage is in reference to the cost to transact in the market and is most associated with the difference between the price you can buy and the price you can sell at for options or stock. If you can buy at $1 and sell at 99 cents, you have 1 penny of slippage. If you can buy at $1 but sell at 90 cents, you have 10 cents of slippage. The more slippage between the prices, the more likely it is to lose out on value when opening and closing positions. This adds up over time. That is why liquidity is so important.
Shake it up, stop when the clock hits 13. Sing 1, 2, 3, 4. Cause no one can do it like we do it, like we do it, like we do it. Cause no one can do it like we do it, like we do it, like we do it.
Decision to build Thinkorswim was a byproduct or derivative of 20 years. In our minds, the future of finance meant that we were going to move away from something that was very manual and move to something that was tech-driven.
What we did with Thinkorswim truly changed the industry. To do it a second time was a challenge that I just had to take. The platform is just leaner, cleaner, a little meaner, legitimately built from scratch.
Having trouble understanding what your trader buddies are saying? Here is what they mean when they say slippage. Every business has costs. Slippage is in reference to the cost to transact in the market and is most associated with the difference between the price you can buy and the price you can sell at for options or stock. If you can buy at $1 and sell at 99 cents, you have 1 penny of slippage. If you can buy at $1 but sell at 90 cents, you have 10 cents of slippage. The more slippage between the prices, the more likely it is to lose out on value when opening and closing positions. This adds up over time. That is why liquidity is so important.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Having trouble understanding what your trader buddies are saying? Here's what a scalp is. We love those quick profits. A scalp is a trade opened and then closed in a short period of time, usually minutes or hours. A scalp is usually done for a small profit and is typically a very directional position. Scalps are most commonly done with future products because of the liquidity and added leverage they provide. But you gotta be careful, it's not always a profit.
Perfect. I would like to buy Park Place.
No,
What?
there is no Park Place in this game.
Yes, there is. I'm looking at it.
No,
I
this
will
is mine.
take it.
It's mine. You don't get it.
Okay, alrighty.
You know what? $500. $500 to the electric company if you want to keep all of your power on all these houses and hotels. And
You can't negotiate. I landed on it. I can buy it if I want
I'm
it.
the electric company. I'm the most powerful thing here.
Excuse me, to the person who owns one property on Monopoly. This is the mayor, and I am overturning everything, and
You're
I'm
in over
allowed
your
to
head.
buy. Excuse me?
You're in over your cute little head.
Don't patronize me.
You
This
don't
is a
come
board game.
down to where the big chimps play and expect to get a banana, sweetheart. You gotta earn it.
Okay, asshole. Give me my money back. Come on, let's keep playing.
Whoa. Whoa. Asshole. No, my father was an asshole. I'm king.
You are so wrong.
I'm very right.
Did you even take a wallet? Did you just eat my piece?
You don't have a piece now.
Seriously,
The
it's a
dog is
game.
gone. The dog is gone. You have nothing. I have a car.
Are you seriously pissed off because you're losing the game?
I'm not losing. I'm winning.
You are clearly losing. Look at the board game.
Every utility, 2 of the railroads, and what do you just have? You have a bunch of hotels and houses, which in this market is ridiculous. A nice, simple house on Mediterranean Avenue, a beautiful car worth 10 times more than your dog who is gone. Got to deal with me. Come on.
Okay, I quit. If you're gonna be an asshole, I quit.
Then I win. The old bait and switch. I got you. I told you I'd never lose this game. I've always got a plan. You fell for it. Boom! Shalaka!
What is going on, everybody, and welcome back to Risk and Reward. Another volatile day in the market, but we'll get to all of that. But we got something else planned for today. But before we get into that, Gus, what's going on, brother?
Oh man, I'm feeling good. It's the first day of the Masters. I got my golf threads on. I'm feeling good. It was we gave back some of the gains from yesterday, but that's okay. That's expected. I knew we were coming down today. There was no way that was sustainable. So yeah, feeling all right on the positions and feeling great on the mental. It's a good day.
There we go. Good. No, good to hear it's a good day. I like the golf shirt. It looks like we got UFOs. I don't know if that's for the recent theme of UFOs over the last few months, but I like it. I don't know if that's blue or purple, but either way, I think it's a vibe. I think with the hair, the stash,
it's a little bit of everything. The spacemen are playing
like
golf. That's the thing. Everything is inverted that I'm doing right now. But
yeah, is that what that is?
Yeah, they're swinging golf clubs.
Yeah,
Holy cow,
yeah.
this is like a challenge. Yeah. Anyway, that was weird. That was hard to do.
No, I love it. Before we get into it, it's been 2 days. I feel like before we talk, there's so much that has happened in the market before we hop back on here. But I mean, what a crazy day on Monday. We talked about that on Tuesday. What a crazy day we saw yesterday after the 90-day pause. And then here we are on Thursday. We got a sell off in the morning, a little bit of a rally. But no, it's been crazy nonetheless. How you been holding up?
I've been holding up well. Yesterday might have been like the best single day of my trading career, at least in terms of intraday P&L. I didn't really. There was a lot of positions that never fully flipped green, but it was insane. I mean, with the way that we were printing after the announcement, and then I expected to give back a little bit of that today. I think the market is going to have a tough time pricing in all of this tariff news and tariff timeline because all we did, move it back 90 days. We at least initially reacted like he said they're just not going to happen at all. Like we're just going to roll everything back to 10%. Yeah. China notwithstanding, obviously. So it's very interesting, and I think that the market is just having a difficult time pricing all that in, and that's why we're seeing this kind of chop that we are. But I knew yesterday was an overextension. There was no way that was sustainable.
No, 100%. And again, we kind of got that pullback today. I know we don't really care too much about the news, but it's always nice to speculate on what might happen. Excuse me. I'm more in the boat of maybe we see a little bit of a rally until we recognize, or if China doesn't fold, then maybe we get a pullback after that. But these next 90 days is going to be really interesting. But I did take advantage when we got the sell-off. I got involved in Tesla. I know we talked about that on Tuesday. Knowing that we have their earnings coming up soon, I still wanted to get some exposure in Tesla. So I got long in Tesla, and then I sold another put spread in SPY. And then after you got into one of those crypto positions, I put something on in Bybit. That was down a little bit over the last week, but that insane rally yesterday put the position back to break even. And now I got like 30 something days left to expiration. So kind of just riding the waves with those ones, just like you and some of those other positions. But nonetheless, yesterday was an insane day. I know I was trading some micros, and I mean the volatility on those is no joke. Like it's no joke trading the micros, especially with that volatility. But we were able to catch a little piece of the pie. But it still kind of feels like, are we in a market crash? Is it a market crash? Are we in the middle of one? I don't know. That's why I'm excited to get into the slides that we're going to get into today, Gus. So what are we getting into right now?
We are going to rank the 8 worst stock market crashes of all time from oldest to most recent. And at the end, we're going to see where the Trump crash lands on the list. So it's going to be a fun one. Market crashes tier list. Everybody loves a good tier list. Let's dive right in.
Let's do it. There we go. Number 1, the Panic of 1873. What is this one, Gus?
Panic of 1873, man. This is the OG. I suppose the tulip bubble in the Netherlands is the real OG, but this is the OG U.S. stock market crash right here. Went from September 1873 to September 1877. 4 years is rather long. Total losses are indeterminate. That's going to be true for both of our first two because they're pre-1900. There wasn't indices, and they weren't really keeping good track of data. But 14% peak unemployment is confirmed. 89 out of 364 U.S. railroads went bankrupt as a result. 18,000 failed businesses in 2 years, which is crazy in a vacuum, and it's crazier when you consider the U.S. population in 1873. So yeah, this is the OG. I've made my tier picks already. We can decide where we want to place it. But yeah, Panic of 1873 is the starting point. What do you got, Errol? What tier does this belong in?
What tier does this belong in? I know after this we'll do our tiered list, but I think I'm gonna have to wait. I'm gonna have to soak in the other market crashes and really dissect some of these to list these. But this one sounds pretty bad. I feel any market crash prior to like 1950 just sounds really dark, and that's the kind of vibes I get from the crash of 1873. I wonder what the crashes were like.
Yeah, look at this newspaper, man.
Right. That's what I'm like. I know it's a little hyperbole, even in the graphic, but I mean, that graphic's not looking to what is it called whenever they use the cartoons and different graphics to depict history? I forget what it's called, but that is a great piece to explain the emotions that was going on around 1873 when the market was crashing.
Yeah, no, for sure. I'm trying. I don't know what that term is called either. But anyway.
Yeah.
All right. Whoever said it, somebody said it in chat. Next up is the Panic of 1893. I'll let Errol take it away with this one.
Yep. Panic of 1893. Again, prior to 1900s, these were some dark days. May 1893 to November 1893. Total losses, intermediate, insufficient data, no standardized indices at this time, just like 1873 was the last one.
Yeah, 20 years apart.
20 years apart. 17 and 19% peak unemployment, whereas the previous one was about 14%, if I'm not mistaken. Led to a 4-year recession, 15,000 failed businesses, and 500 failed banks. The way that I see it, Gus, a little bit of an improvement. I mean, 15,000 failed businesses when the previous one was 18,000, but unemployment was peaked about 4 to 5% higher. So took a little bit more of a hit there. But I'm gonna have to rank this one. This one is gonna go hand in hand with the previous one. Again, we'll wait to rank these ones. But again, tough days before 1900s. I don't know what you feel from the 1893s or what you've heard before this, but I see over here we also have the War of Wealth. So maybe a lot of wealth transfer around this time. Things are new. It's prior to 1900s.
Yeah, this one, I don't know. I agree. I feel like this one is maybe just a little bit less severe than 1873. They're very similar. This one you have the banks failing. Previously we had the railroads failing. So two sort of different things, but almost 1 in 5 people being unemployed in the entire country is pretty wild to think about.
That's insane. Yeah, no, that's insane. Now, this one, Gus, the Great Depression. That just sounds depressing.
This is the
photos in black and white. The photos in black and white. But what do we got here?
Yeah, there's just no question. This is immediate S tier. This is the GOAT stock market crash. But 10-year depression, October 1929 to 1939, October 1939. The Dow Jones fell 90%. we think it's pretty crazy that we're dropping 15 and 20% these days. 90%. There was 25%, essentially 25% peak peak unemployment, which is even crazier than the previous slide. 1 in 4 people are unemployed in the country. 16 million shares traded on Black Tuesday, which that doesn't sound like that crazy of a number now, but proportionate to the population at the time, that was completely absurd.
And the access to the market,
Oh, yeah. You had to, I don't even know. I actually don't even know. Could you call? Were there phones, reliable phones at this time? I don't even know how stockbrokering worked before we had phones, man. But anyway, also kept FDR in office for 4 terms. World War II was obviously a big role in keeping FDR in office as well, but the Great Depression was no negligible part of that. This is the GOAT. There ain't nothing greater. This is the Great Depression.
AKA, this is the Michael Jordan of recessions or market crashes, if you will. But I know we call this one the Great Depression. And again, if I'm not mistaken, we stopped calling it the Great Depression after the Great Depression because of how depressing calling it the Great Depression was. But I mean, there was reasonable doubt. I mean, Dow Jones falling 90%. I mean, I think that justifies calling something a depression. And then, 25% peak unemployment. I mean, that's insane, So a 90% pullback in the market, might cause a lot of depression, especially with the black and white photo. I think that's a cherry on top, guys.
This is one of the iconic Great Depression photos is the 4 children for sale picture. Wow. But anyway, that takes us right into our next crash here, the recession of 1981, 1982. Take us away.
There we go. So July 1981, the recession that lasted about a couple years. S&P fell about 27%. So not as aggressive as 90% in the Dow Jones, but 20% is still a hefty pullback. 10.8% peak unemployment, not as bad. But when I think about how this is the 1980s now, that sounds pretty bad considering it's near the 2000s. Triggered by tight monetary policy, original goal was to curb inflation. Sounds like we've been dealing with this inflation problem for quite some time now, Gus, because this is 1980s. So, same problems, different day. But 27% pullback in 1980s in the S&P 500, that's a pretty decent market crash.
Yeah, no, I definitely agree. It just makes it all feel more real. I don't know, being this recent and having color photos and everything like that. But I agree, it does. 10.8% unemployment in 1981. It strikes you more than 25% unemployment in 1939 for some reason. This is a slept on little mini recession. You don't usually hear people bring this one up when you talk about major crashes or recessions, but felt it was worthy of a spot here.
Yeah, it lasted about almost half a year. So, it gets a slot up there. The OG, I feel like this isn't the GOAT. It's not the Jordan of crashes, but I feel like this is an OG. What are your thoughts on it?
Yeah, it's certainly got a high ceiling. It's a promising crash. We got the dot-com bubble burst. I also feel like this one gets overshadowed a bit when people talk about the greatest crashes of all time, and it's primarily because it only affected the NASDAQ. Well, not exclusively, but primarily affected the NASDAQ. Dot-com bubble burst. March 2000 to October 2002, the NASDAQ fell 77%. And again, we're talking about the early 2000s here. This is not no Great Depression, 90% fall. This is real and recent. People obviously remember this. NASDAQ fell 77%, 6.3% peak unemployment. It was fueled by massive speculation on internet companies, and most of those internet companies had unsustainable business models. I'll throw out an example. My dad tells me a story often about in 2001, which is the year I was born, I might add. He got a computer for free, and the business model was that for 3 years, the computer that you bought would have a strip of ads down the side. And then after 3 years, you had done your time, and the ads would be removed, and then the computer was just yours. And the company went under 2 months after he got the computer.
Wow.
And so then the ads just went away, and he won. So it was basically a free computer.
Wow. 2 months, that's a quick turnaround.
Yeah, no, exactly. And that's how this bubble was, as these companies would come and go, and they all had wacky business models. And this is a significant little crash.
You know what's really interesting though? This has a NASDAQ pullback of 77%. That's massive. If we see something like that today, people are going to think actual UFOs are coming down or something. Nobody's going to care. To see something like that in today's age would be crazy. But I don't know, just right off the bat, is it much of a surprise? It's the dot-com bubble. It's one of the OG market crashes. The dot-com bubble, I think, can be just the headline itself is easily recognizable. But the internet really shifted how we do business into 10, 20 years after the dot-com crash. I think the internet coming along was one of the biggest technological advances we've seen, in society. So is it a coincidence it pulled back 77%? I don't know, but that's what first comes to mind when we see the dot-com bubble.
Yeah, I've been drawing comparisons to the AI bubble right now, if you can call it a bubble as well. But it's it's clearly going to be the future, but it's incredibly oversaturated. Anyway, go on. Great Recession. Tell us about this one. We got another great one.
That. The Great Recession, December 2007 to June 2009, a little bit longer, a couple years. S&P fell 57%. 10% peak unemployment precipitated by collapse of the housing bubble led to the Dodd-Frank Act being passed. This one, let's see, what was I? Swinging on a swing set, I think I was doing while the market was crashing, not knowing my friends' parents, everybody was losing jobs. I didn't know things were hitting the fan at this time. I'm over here at recess. But I got to say, this is probably one of the more memorable ones. I would say, yes, obviously I was around for 2020. Now we're kind of living through 2025. But I think the 2008 one is one that I became most accustomed with. And I know it had a lot to do with the Lehman Brothers and, I mean, the housing bubble, really sending assets to the ground. But I would rank this one. I'm going to rank this one up there. I think this one's the most memorable one, at least. That's what I have to say about that before we start ranking all of them.
Yeah, I certainly agree. And we are about to throw all these on a proper tier list at the end, everybody. Don't worry about it. But yeah, I agree. I have this one high on my list.
Most definitely. Now, the world's famous market crash right here. What do we got for last but not least?
Well, we got two more. We still got to talk today. But yeah, no, this is the COVID-19 flash crash. Everyone remembers this well. This is when I started trading. Was pretty much smack in the middle of this situation. I believe March 2020 is when I placed my first trade, which is generally what people associate with.
So did you hear something about? Did you hear a headline or what went down when you got into the market around COVID?
No, it was quite the opposite. My senior year of high school got canceled for the remainder of the year, and I was bored. And I was reselling shoes at the time. I was looking for other avenues to make a little capital, and I realized that with options, you could make what I make on a pair of shoes in 10 minutes if you play your cards right. And so that was my introduction to options trading. And I've mentioned before, but after this year ended, I was like, well, where'd all the volatility go? Well, what do you mean I can't just get a 250% gainer in a day as long as I pick the right direction? Right. But anyway, February to April 2020. That's why it's called a flash crash. Just 2 months. S&P 500 fell 34% at the lowest, with 14.7% peak unemployment. Obviously, this is a different situation where the markets aren't driving the unemployment. COVID is driving the markets and the unemployment. But yeah, it was triggered by the global outbreak of COVID-19, a virus everyone has come to know so well. And there were unprecedented economic shutdowns. Everybody remembers, I'm sure everybody has a funny quarantine story that they could share. I was working at a UPS store at the time, so I got an essential worker badge. I was swinging that thing around like I was amazing. But flash crash, respectable crash, quick recovery, and had to make the list here.
Yeah. Quick recovery. I know we're going to rank these here in a little bit. We got a few minutes left. COVID. I mean, it feels like it was just yesterday. It's crazy to even think it was about 6 years ago, maybe 5.5, barely over 5. I mean, it's April right now. So it's crazy to think half a decade has passed. Feels like it was yesterday. I mean, I think the recovery of the COVID crash really dampened the weight of this move to the downside in terms of how it felt whenever we had that market crash. So we'll leave it at that one. We got one more. Liberation Day, April 2025 to when? Are we still in the middle of a market crash? But the S&P fell 17.6%. Peak unemployment still is to be determined. S&P 500 fell 5.5% on April 4th. S&P 500 rose 9.5% on April 9th. 8th largest intraday gain in the S&P 500 history. So, I mean, we're living through some historical times right now, and we'll be able to fill in the blanks with these shortly, maybe sometime this year. But I know we're still going to rank this one, even though we're still in the midst of it. But I'm excited to rank this one. I'm curious where you're going to place this one. And I already have in mind where I'm going to put this one, Gus. So what are your thoughts on this before we go ahead and rank all of them?
Yeah, I'm interested to see where this one's going to go as well. I suppose the only thought I would have is that as we look at all of these previous crashes and then we look at this one, it's important to remember that just 20 years ago, the definition of a bad crash was losing 77% on your main index. So maybe we shouldn't freak out too much about this 17%. I think we'll be able to get out of this hole.
I mean, I think we've been absolutely spoiled, guys. Because I mean, again, just looking back at the old data is a really nice reminder. But I mean, I can imagine if we got even a 77% crash, let alone a 90%, when on a downtick, it feels like everything's hitting the fan. But anyways, no, we got a little bit left. We're gonna have you go first.
Yeah, let's just go one by one. We can both give our rank and then we can argue about it if we need to argue about it. Let's start somewhere easy. Great Depression is S tier, no question, right?
I would absolutely agree with it. Yeah, of course.
Yeah,
it's the Great Depression.
It's the Great Depression. Got it. So yeah, that's auto S tier. Well, what do you want to do next? I think it's also fair to put Great Recession in S tier. That's my only other S tier that I have listed.
That's fair. All right, what photo was
it's
this
the
one
third
for the
one?
Great?
Yeah.
There we go.
That one.
There we go. Oh, bear with me. There we go.
You're good.
There we go. I mean, COVID. Don't run around COVID. Most recent, most relevant. Very integral time period of our life. I would actually say COVID, I think, was the lightest market crash of all the examples that I have. What are your thoughts on COVID? I think the quickest recovery, I believe, in history of a market crash. And I mean, I feel if you blinked and you didn't look at your portfolio for a couple weeks, you didn't even realize we crashed. So
I
that's
agree.
where I would leave that one.
I agree. I had the exact same thought process on this one.
Okay.
I think that it's iconic, it's recent, it stands out, but in the broader scope, not that crazy. I think B or C tier is fair here.
That's fair. We're gonna go C.
Sure. Gotta leave some room. All right. What about our panics? What about our two 1800 panics? Personally, I'll go 1873 first. I think 1873 deserves an A tier just for being the OG. It's not the craziest crash we've ever had, but I also don't want to misjudge it because we don't have market information. It could have been like 60%, and we wouldn't know.
Right.
So yeah, I'm feeling like this one deserves A tier for the notoriety. This is subjective, by the way. This is totally subjective.
Absolutely. It's subjective, but not really. No. I would agree. I would think that the graphic definitely does it justice. I mean, this was 1873, and I think it depicts the stress and depression that was felt during that time period too. But I would say definitely before 1900s, don't have all the data, but that's a fair rank.
Yeah, and then in that same vein, 1893, kind of thinking B tier. Feel like it's the same thing, but it's just not the OG.
It goes hand in hand.
Yeah.
I would absolutely agree. Surprised this one is even in color, I will admit. So we can definitely give that one B tier.
That's true.
What do we got? We got Charlie Munger on this right one, or that's Charlie Munger, right?
I think so. I'm not sure. I clearly, if anybody
like
was here Tuesday, I clearly am not super well versed on Charlie Munger, so I don't know. I don't want to speak on it. But anyway, yeah, we can go. That's recession of 81, 82. This one I have lowest on my list. I actually put D tier. Just because we can't have this big cluster at the top. Making this list at all means that you're a pretty legendary crash in the first place. So
that's valid.
This is like being the worst player in the NBA or something. Like, you're still really good.
It's still an achievement. Absolutely.
Exactly.
You might get dogged on from some fans, but they're sitting at home, typing from their couch. So
exactly. Yeah, and then .com bubble. What do you think about .com bubble before I give my take?
I don't think it has been that bad yet, but if we don't get the quote unquote correct outcomes, I do think it has potential to be one of the worser ones. I think it has the potential, just because I do feel we've been putting a Band-Aid on a bullet wound for the past who knows how long now, even prior to 2020. I feel we've always been putting a Band-Aid on a bullet wound. So if things somehow were to get bad, I think we're in a great position for things to really pull back. So I'd actually have it a little bit more high up on the list than I think you might have anticipated. But I want to hear your thoughts.
.com bubble. I mean, I think B tier is fair to me. Just because I have to take.
This one's a .com bubble.
Yeah, .com bubble. Yeah. We'll do modern last. But yeah, I have to go B tier here. I think it's, in terms of notoriety and historical significance, maybe worthy of higher, but it really only affected the NASDAQ, so I have a hard time kind of quantifying that one.
No, that's valid.
I say B tier. And then if I do have on my end, I don't know if we can cut over to me real quick. I have I got our picture here for the last one. I don't know why I didn't update on your end. I don't really know what I'm doing making these tier lists. I just try my best.
No, I love it.
Anyway.
What are your thoughts, though, on the one that we're kind of living through right now, though? I kind of gave my piece on it a couple seconds ago.
Yeah, I think in terms of this modern Liberation Day crash, I'm hopeful that it will be short-lived, the way that the COVID flash crash was. Obviously, there's no certainty surrounding that. But I think that as I said on the slide, when you contextualize it in the broader scheme of all of these massive market events that have happened, it does start to seem relatively minor. I mean, you know, when you talk about just 5 years ago, the crash that we had was 34%, and obviously we recovered very quick, which kind of equalizes that out. But 34% is a massively significant number, and we're not hitting that with this. You know, I mean, hopefully, I don't know. We're not at the end of it. There could be lower lows to be had as well. So I don't want to speak out of turn. But at this time, I would have to quantify it as, I think I would say B tier. I think I'd say B tier as well. I don't know. I don't know if I think it's as significant as the dot-com bubble or not. It is affecting all markets and indices. So tough to nail that one down. But I have a B tier.
I think it has the potential to be, you know, as a popular headline, like something like the dot-com bubble. Really, the way that I see this one right now, I feel like we're at the beginning. Like, I feel like we still have to see how a lot of these tariffs are going to unravel. And I think that's going to be the that's really going to be the catalyst for what if we see more upside or downside. And I think we're in the midst of a lot of uncertainty when it comes down to tariffs. So I would rank it at around the same spot. I think it has the potential to see. I think it still has potential to see more negative impact, but it really, again, just depends how we play out. But I just feel like we're 40%. I feel like we're in the second quarter right now. Best way I can describe it.
Yeah, I'm inclined to agree. But yeah, I know we're at time. You can go ahead.
Cool. Awesome. That was the market crash list. We'll see where we're going to be ending up within the next couple of weeks again with all the tariff news. I know we got PPI about an hour before the bell tomorrow, so we'll be looking out for that. But anything else to add before we hop on out of here today, guys?
Yeah, no, nothing to add. Big week of earnings next week. I think it's just going to be continued volatility. So everybody strap in. It's a fun time.
Yeah, we'll come back on Tuesday. I'll update you on that Tesla position that I have on. Again, I know earnings is right around the corner on it, but we'll manage it best that we can. But thanks for taking the time to join us today. Be sure to stay tuned for more segments coming up on next, and we'll catch you guys next time. Peace.
I'm not being fed information, no.
In fact, I'm working with Deep Throat.
We're working on it.
Got a beautiful new setup here. I got like this. It looks like I'm.
Put the lotion in the basket.
I don't know what you're listening to, but it sounds normal to me.
We're working on it. You sound great, Tom.
Thank you, Beth.
Could you just say, Luke, I am your father? Could you just say that once?
No, I'm not going to say that.
Could you just say, I'm Batman? Just say, come on.
Beth, are we going to be able to fix this, or am I destined to
actually, Tom, we fixed it. You sound perfect now. They just fixed it.
Are we going to be able to fix this, or
no? They fixed it.
I promise. We're working on it.
Let's just tell Tom we fixed it, and he sounds great. Okay, so we can just move on. Does that sound good?
I have a complex.
It sounds like a Green Giant commercial.
People are writing me, but don't worry, we're going to fix it.
Don't worry, children are hiding under the bed right now.
Well, this is me. Thank you so much for tonight. I've never been to the Hard Rock Cafe before. That was really fun.
Bow, bow.
Okay, well,
This is a song for the broken hearted. Bow, bow.
Okay.
Hey.
All right.
Why don't we get up there and you can lay some hands on me, and I'll see if you're slippery when wet.
That's really inappropriate for a second.
I want to lay you down on a bed of roses and send you off to Slumber Town in a blaze of glory.
No, don't say things like that, because my boyfriend was an aerial artist and he used to do things like that.
I might be Monday now, but someday I'll be Saturday night. You give life a bad name. Whoa, shake it up just like bad medicine. Bad medicine is what I need. I'm going out in a blaze of glory. Take me now, but know the truth. 'Cause I'm going out in a blaze of glory. Lord, I never
first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
Nikki Batt, University of Kansas. Number 20, because that's how many underlines are in my portfolio.
Rick Welch, Illinois Institute of Technology. Number 23, because I'm trained 23 hours a day.
Dr. Data, Louisiana State University. Number, square root of 1 over 365, because that's the square root of time for one day, which is multiplied times the stock price, multiplied times the implied volatility, which gets you the projected stock price for one day.
I like the looks of that lineup.
Well, being mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
I'm AJ Rudolph. I'm a senior product manager here at Tasty Trade, and I just qualified for the World Poker Tour $5 million free roll in Las Vegas on Friday. So I've been playing poker for about 20 years, actually. I started just with friends. It was like 2005, I think it was, where everybody was like, yes, let's go play poker. There was a huge boom around poker. And I actually feel like that is coming back around again. Right now, there seems to be a lot of interest, and the fields are growing, and everybody wants to get in there, and everybody has a chance to win. That's kind of the cool thing about all of these big events. I feel really privileged that I have the opportunity to go and do this. This particular tournament is only 2,000 people. You cannot buy your way into it. You have to win in order to win your seat, and that's what I did. And so I just buckled in and played my game and really focused and won my seat. I'm a very aggressive player. I do rely very heavily on reading the players at the table. I think that's super important. To be a balanced player, you want to make sure you're doing the math, you're reading the people, and you're doing all of those things in combination with each other, so that way you're using all the tools that are available to you.
So why are we all doing all the things that we do inside of the active trading space? Simple. To make money and generate returns. Well, inside of the Tasty universe, there are essentially 5 keys to making those returns, and in this crash course, we're gonna break down all the details of each one of those keys. So I'll see you inside.
Oh, yeah, it is Thursday, April 10th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for The Price of Truth, the podcast where we like to explore the incentives that govern our world. Good God, there are a lot of incentives to chew on. More on that in just a bit. Before we get started, it's a very special episode today. We've been teasing it out all week. We have with us the man, the myth, the legend, the founder, and the creator, Mr. Thomas Osnoff. Thomas, thank you very much for slumming it with us here, pulling the graveyard shift. I know it's been a long day for you, but thanks for joining us on The Price of Truth.
I've been looking forward to this, Mr. Jones. Looking forward to it.
Don't lie to me. Don't lie to my face. I'm obviously, this is a turbulent time in the marketplace, and I'm looking forward to having a conversation with you, a deep, longer form conversation with you. Every Thursday we get a chance to go back and forth. It's generally sort of a debate style. It's generally political oriented, and frankly, I want to dance on some of those topics, man. But I think there's a lot of people out there that can benefit, as I have, from just hearing you talk about navigating turbulent times. And so, we're going to have a little bit of everything today, if you don't mind, Tom.
I have no idea what you have planned, and I am wide open. Nothing's off limits. Fire away. Don't be shy.
A little bit of a trust fall. Before we get started, everybody out there, shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't have both, go do yourself a favor and get them so you can manage your risk 24/7. But if you want to be part of the conversation that's in the middle of your screen, there's only one place to do it, and that's on Tasty Live's YouTube channel. So head on over to Tasty Live, subscribe to the channel, and jump into the chat. Start banging your phalanges and metacarpals on the keyboard. The more you type, the more active you are, the more Google's going to put us in front of as many people as possible. We can save the world one view at a time. Thank you for indulging my sort of corny opening here, Tom. I'm going to ask you a super simple question, my friend, to open up conversation. Give me sort of your 30,000 view of what is unfolding from a risk perspective. Give me sort of a 30,000 foot point of view of what's happening in risk and whether you're concerned right now or feeling opportunistic. Let's start there.
I think the day you get concerned and you don't feel opportunistic and you don't feel like you're an opportunist as a trader, you are completely fucked. Like you can't do this business if you're scared. You have to be, essentially, as a trader, every day you have to view it as an opportunity, because as soon as you play defense, it's impossible to open. You can only close, adjust, do whatever. You have to look at it as an opportunist. There's no such thing as a scared trader. They're not successful. There are scared investors. Let's talk about the difference. There are definitely people that are passively invested or maybe more actively invested in things. And I think that they get scared, and they have every right to be, because I don't know if they, how much they understand about markets and market structure. And I kind of think of, finance and investing as a little bit foreign to them. I feel like I'm an insider in the sense that this is all I've ever done my entire life. And I've watched every tick of every day on the tape for as long as anybody can remember. So I don't feel like I can never be nervous. I can never be scared. I can reduce my size, but that's about it. So I have to always be an opportunist. Let's put it that way. I do think that there's no question the marketplace, the fear index inside the marketplace, I mean, it was flashing today like the sharks were circling in shallow water. So if you were swimming today, if you're a surfer, here's an example. If you're a surfer and you live in the water, essentially, and you're always out every day, you can't worry about sharks even though they're out there. If you're a casual go in the ocean like once every 3 years, like me, you could be damn scared of sharks, And so in the trading world, I'm a surfer. In the swimming world, I'm scared. I'm scared of the ocean, but in the trading world, I'm not scared of the ocean.
Makes sense. Walk me through what you were thinking. I know you were watching them. I know you've been watching every tick for the last week. I've barely got any sleep for the last week or so.
Yeah.
I'm walking around like a zombie most days. Take me through what you were thinking I think it was your night. I'm 13, 14 hours ahead, so I don't know how to frame time for you. But take me through what you were thinking the other night prior to that 9.5% rally, when yields are sort of spiking, the 30 years hitting 5%. What were you thinking? And for people that don't understand why that's important, let me set the table. Bonds, U.S. Treasuries, are the underlying collateral of a debt-based monetary system. And so when you see extreme volatility at the underlying collateral level, that is a big problem, because everything else in the system is built on top of that, usually with leverage. So when you're seeing things like that, the 30-year just go parabolic up to 5%, that's a very unprecedented sort of situation you find yourselves in, and there's a lot of warning that comes with that, a lot of concern. Take me through what you were thinking as you were watching that occurring, and what calculus goes through your mind.
Well, I got to tell you, it was probably the only night that I had trouble turning off my screen, because, I'm kind of a junkie. So in the middle of the night, I'll wake up and I'll just look at the market, but I don't usually trade. That night, which was
I think it was Tuesday night. I at 1:00 in the morning, I'm like, oh my God, if I don't go to sleep now, because I get up at 4, I'm like, if I don't go to sleep pretty soon, I'm going to be so messed up tomorrow. But I did trade bonds around 12:30 or 1:00 in the morning when they got into the 111 handle, and I bought some. And I'm thinking to myself, I just bought some earlier at 113.23, and then I bought some at 111.31, and I bought some earlier in the day at 115.07. So like it's scary that I know all this stuff, but I don't forget those trades. And I don't like buying things 3 handles lower than where I just bought them a couple hours earlier. So something was going on that was bothering me. So I stayed small, but something was going on, and it did make me, start to wonder. And I've always thought that the sole purpose for the Fed is to act as catastrophic insurance if something was to go horribly wrong. And I kind of felt like this was the first time in a while that we've seen something. I'm not going to say catastrophic at all. I'm just going to say this is the first time we've seen something go horribly wrong, because bonds shouldn't be down a little over 10 points in 3 days. It didn't make any sense to me. So I was trying to figure out how to rationalize it and how, just trying to figure out what was going on. I've seen huge bond moves, but I've never experienced a crash in the bond market. And I'm not going to call this a bond market crash, but I am going to call this a real destruction of wealth in the bond market, because this is just the listed bond market, and then there's the OTC bond market. There's probably, a good $10 trillion evaporated this week in interest rates, when everybody's sitting around going, everybody knows that. Well, I shouldn't say everybody knows. A week ago, there was all these crazy, conspiracy theories or just ideas that, this is all kind of a, the whole tariff thing was an effort to create enough panic so there'd be a flight to quality in bonds so that rates would go lower so they could refund the deficit, the interest rate cost of the deficit at a much lower cost, and which is all complete garbage. It's total bullshit. We all knew that, but people love that story. Well, this threw a giant wrench into that whole story, and the only thing people could come up with was, China's just blowing out all their bonds. But the reality was, it probably was a little bit of China, but it was probably a lot of the rest of the world. And it was probably, something that was truly unprecedented. It's still happening right now. Bonds are 113.18, right now, and they were up to 116, and they were 3 points higher this morning. And what's happening right now is that, or at least this is how I'm rationalizing it, the rest of the world has found that we are vulnerable, and they are taking advantage of it in a way that we haven't seen in a long time. And they are creating a lot of chaos. There's a reason that the VIX was up 25% today. There's a reason that our bonds were down 3 points today. There's a reason gold was up $100 2 straight days, and it's up another $20 tonight. There's a reason our stocks were down 200 handles, or 3% in the almost 4% in the S&Ps today, because we've been exposed. We've been exposed through I call it intellectual laziness, through lapses in just fundamental economic intelligence, and we've been exposed. And in the past, it was hard to get the rest of the world to exercise on exposures or cracks in our system. Now, everything's so much easier and everything's so much more universal that cracks in our system, they can be taken advantage of. And that's what's happening here. That's why the US dollar is getting absolutely annihilated. Today was one of the worst days I've seen for the U.S. dollar ever. That's why our bond market is in crash mode. That's why our stock market is in crash mode. And the lapses, the intellectual lapses in policy, the intellectual lapses in like logic. The world's too smart for this crap anymore. The world used to be financially, the world was pretty financially illiterate, and we had such an edge. There's no edge anymore. Like that edge doesn't exist. And we're being exposed. That's all it is. And you don't negotiate with terrorists. And we're essentially the terrorist. So we're a terrorist who's being exposed. You know what that is? That's the worst combination. And that's why our bonds are getting crapped on. That's why our stocks are getting crapped on. That's why the dollar is getting crapped on. I mean, it's not too hard to see from the outside looking in. You've got rank amateurs making very important decisions. Like, I think if you had a really open interview with Jay Powell here, or you had a really open interview with, you sat down with Bernanke or somebody that just has a different perspective, an objective perspective, you would get some answers that would blow your mind. They would blow your mind.
What do you mean by that?
Just because I think that if you talk to people that were objectively neutral, and I mean, some people may say, well, Bernanke wasn't neutral. Well, let's just say, let's argue that if you went to a handful of past, Fed chairmen, you took Yellen, you took Bernanke, you took Jay Powell, you took whoever's Greenspan, who's ever alive still, okay? And you put them in a room together, just everybody you can name. I don't care what side of the political aisle they're on. And you put them in a room together, you would get a fairly universal consensus of what we're doing right now is idiotic. And I don't think that there's enough discourse right now. I don't think that there's enough objectivity. I don't think that there's enough, true discussion on the policies that we're having. We are, I don't think we're purposely exposing ourselves. I think we're intellectually deficient. And for that reason, we're exposing ourselves.
Can you expand? Where are the areas? So here's what I think. Here's my very simple, model of what is being attempted. Here's the simple version: is that we are exporting dollars to the world. In exchange, the world exports goods to us. They accumulate an excess dollar savings and we get cheap goods. Without a trade exchange, with dollars. The world accumulates excess dollar savings. What do they do with those excess dollars? They come buy U.S. financial assets. In exchange, so the U.S. financial assets allows us lower borrowing costs than otherwise and higher stock markets prices than otherwise, more capital formation here, more entrepreneurship, so on and so forth. And the issue that's trying to be solved is that those excess dollar savings, when they come back into the United States, while they do benefit us all, while you get higher stock prices, you get lower borrowing costs, you get cheap Chinese or Vietnamese goods that come back into the United States, that there's a proportion problem, there's a distribution problem. And that distribution problem is then accumulating lots of political power within the hands of few, more political power and less political power in the hands of many. And so what do you do about that? And I, the attempt here, right or wrong, I'm not trying to justify it. People call me a populist. I'm not trying to justify it. But what the attempt here is to say, okay, let's see if we can start exchanging more goods for goods so that we're exporting less dollars. If we can do that, that will change our debt trajectory. We won't be on a parabolic debt trajectory. Perhaps we can lower our debt trajectory. What that also means is that, and if we can get the rest of the world to invest in U.S. CapEx instead of just financial instruments, then we can create additional distribution opportunities through work instead of just handouts. I think that's the idea, or some part of a very simplistic mindset of the theory behind it. How would you respond to just my read on what the attempt is, and then break it down for why
except
this
for
doesn't work.
Except for the concentration of political power, political clout, I would agree with the assessment. I just don't agree that is my issue is I don't doubt that that's what the vision is. I just think it's absolutely the wrong vision. Like, I don't think you solve. First of all, I don't know that you have to solve the debt problem. I mean, I think you said it. We have virtually no unemployment. We have the strongest capital base in the world. We have the strongest stock market. We have the largest GDP. I mean, we are consumers. We're a consumer nation, and there's no importance or value to raising prices intentionally for the sole purpose of spite. But I think that the miss for most people, or the miss in all the logic, is there are better ways. There are better ways to reduce the deficit than there are to raise prices. That's number one. And number two, if you wanted to do that, if you really wanted to do that, and you wanted to do it in a way that in 2025, the way countries collaborate, governments and businesses collaborate, and we're on a global trade thing, then what you do is you sit down and you negotiate that, and you make it even for both sides. You don't put a gun to somebody's head and say either move to the US or F you, because they're going to say, F you, we do not negotiate with terrorists. This is the whole issue here. It's how it's being done. We're using old school bullying techniques in a modern era where that's not how stuff gets done. Nobody is going to respond to that. Nobody. And you're seeing that even small countries, big countries, everybody is saying, you know what, we'll do business with anybody else, but we're never going to do business with you. And that is the right answer, because you wouldn't do that either. Like, nobody would do that in their right mind. That is the old school technique of, listen, we're the biggest player, and you know what? Either you play with us or we're going to do it ourselves. It's just, it doesn't make any sense. Nobody does business like that anymore. And so if you want to do business and you want a fairer trade relationship, you negotiate it. You don't just say, hey, you know what? We're going to tariff you and you can tariff us, and we'll go back and forth, and this thing will blow up out of control until what happened yesterday, which is why the market sold off again today, until what happened yesterday, which is all the biggest players and all the biggest donors and all the biggest backers essentially went to Washington and said, hey, this is idiotic. Lighten up or we're out. And that's exactly what they did. That's why they peeled back and basically sucked it up and called everything off, because everybody is saying this is idiotic. You know what? We have to stop sitting here and thinking that, because one person wants something and an entire nation doesn't, that this makes sense. It doesn't make sense. You want to reduce the deficit, okay? You don't cut entitlements. You don't blanket cut expenses, because that's part of our culture, right? And what you do is you use with today's technology, you use smart technology to improve the way we spend money, and then you fix our tax code to generate trillions of dollars in revenue from people that are not paying any taxes right now, rather than trying to make other countries pay tariffs to us that are going to offset the tax losses. It doesn't make any sense. The way we're approaching this.
Let me ask you just to specify, when you say fix the tax code, because I've heard you say that many times over the years.
Sure.
To me, I think sometimes that comes off to me as sort of a hand wavy thing. Fix the tax code. It's like,
really?
So what? No. Listen. Meaning what? Like, okay, that's like, to me, I go like, fix wealth inequality would be like a hand wavy thing. I know it's true, but tell me more, type of thing. When you say fix the tax code, are you in a way sort of saying we need a wealth tax in America? When you say that, like, in effect, are you saying we need to tax labor less, tax wealth more? I'm just wondering if you have any specifics around what it is you mean when you say fix the tax code.
I have a lot of specifics around it. First of all, the concept of using tariffs as a replacement for fixing the tax code.
Yeah,
whatever. It's a consumption tax. Same.
It just pushes it down to all of us. It decreases demand. Instead of going straight to the wealthy and going, we printed all this money. It worked through the economy. It didn't cycle. You guys hoard it. You're buying assets. You're not selling it. And so we got to do something about this. Otherwise, we're just going to keep printing money, increasing the debt, decreasing the living standards of the people, and increasing the size of your bank account.
So what tariffs do actually is that they raise the taxes for everybody, especially the people that can least afford it, because across the board, it is a consumption tax, and across the board, everybody spends a ton more money. It makes absolutely no sense. What happens in this country and what's broken is that there is the taxes on the wealthy, and I'm not talking about because there's all these tax advantages or there's all these tax shelters, but you have a president that hasn't paid taxes in 20 years, okay, that starts at the top. And you can go all the way down the line to billionaires. Even Warren Buffett is famously quoted as saying, it's ridiculous what I pay in taxes because it's not right. And all these billionaires know that. And all these corporations, Amazon hasn't paid taxes. And you know why why Bezos backed Trump is because Amazon hasn't paid taxes since their inception. I mean, this is ridiculous. You're talking about $3 trillion company, a company worth $3 trillion or $2.5 trillion now that hasn't paid taxes in 15 years. Apple doesn't pay. They pay, but it's a minuscule amount. I think it's like 8%. So what we have here is you have somebody making $70,000 a year that pays 30% in taxes, and you have somebody making $7 billion, or made $7 billion that's paid zero in taxes. The system is broken. And if you want to fix the deficit, make the tax code fair. And it's easy to make the tax code fair because you can make the tax code and if you can figure out how to charge more money for a Cubs game against the Dodgers on a Wednesday afternoon, on a Friday night versus a Wednesday afternoon, you can figure out how to fix the tax code for a social worker that makes $50,000 a year and a CEO that makes $450 million. Okay, this is not rocket science in this year. And if we correct the tax code and we improve our spending habits, which is on a government level, does not mean cut everything. This is not doging it, which is idiotic. This is just putting ourselves in a position where we are fiscally responsible, which is not that difficult to do. Again, one of the beauties of AI, one of the beauties of today's technology is all this stuff that everybody's complaining about and saying can't be done can basically be done and written almost overnight. It's not that complicated anymore. And that's how you start. And then you go out and then you make deals with all your trade partners so that it's fair both ways, because we all are at the top of the food chain. What we're risking right now is something way greater than anybody in Washington can imagine. We're risking blowing up, being the center of the world as far as finance goes. We're blowing up our chance to maintain that role as essentially leader of the world when it comes to pools and pools of liquidity and fresh money.
Let me ask you, because we try to talk about incentives here. I don't disagree with anything you said, and I've said similar about more focusing on the wealth tax versus the more comprehensive solution I think you laid out. We need to make progress on that. But my issue is I'm trying to see the world through a pragmatic lens. How exactly in a world post Citizens United, Tom, where you can have unlimited contributions by the ones benefiting from an existing system, how exactly do you get a politician funded on either side of the aisle that then gets the votes to enact this type of legislation and then turns around and taxes the exact same billionaires who own those corporations, who own those assets, and turns around and taxes them some percentage of their wealth, closes their tax loopholes. I hear what you're saying. I just can't see the incentive structure that allows it to happen on either side of the aisle.
Well, it happens everywhere else. It happens everywhere else in the world, Victor. So it's not like you're making it seem like it happens everywhere else in the world. It's doable, and it's always been doable. You know, this is the first time that I can remember where you could actually buy, where policy was up for sale blatantly. This is the first time where I've seen blatant sales of whatever you want. You want TikTok? Give me $200 million. You want me to reduce capital gains? You want to remove income tax for billionaires? Just give me $200 million. Give me $400 million. Give me $1 billion, whatever it is. And this is the first time we've ever seen this on this scale. The grift we're watching right now this is not what America's about. This is not what our democracy is built on. This is a very dangerous time. And you know what's really scary about it is that we have an entire political party that is so petrified of saying one word, and we've never seen that before. We've always seen people from inside their same party. You know, if it's Republicans, there's always infighting. If there's Democrats, there's always infighting. You know, you can fight across the aisle, of course, but there's always people inside the party that go, you know what, this is crap, this is bullshit. Now nobody says a word. What does that say? What's happening? What is freaking happening?
Can I two quick things? Maybe just one. Do you think that power within the Republican Party, do you think that comes from the individual, or do you think that comes from the base that individual has? In other words, is that the democratic system when you have a large base that seems very supportive of your policies? That's sort of how democracy works. I'm not trying to apologize. I'm trying to set up premises for you to give your opinion on. Yeah, some would look at that and they go, well, if he's got a decent approval rating, if he just won the election, he won the 7 states, sure, wouldn't it be really difficult for a Republican with that level of support, especially if in his state or in his senatorial district, whatever, or congressional district, wouldn't that be moving against the will of the people if the people support these policies?
Yes, 100%. You're 100% correct. And if the people support the policies, then the person they elected, within reason, playing within the rules, that should not be an issue. But there's a lot of things that should scare you, especially when the person that they elected didn't respect a peaceful transfer of power the last time when he lost. And that should be scary enough, among other things. But not to mention, criminal convictions, not to mention leading an insurrection against his own country. Those are things that should be red flags. I mean, listen, you can say whatever you want. I don't give a crap if he sleeps with some hooker. I could care less. That's doesn't mean a damn thing to me. But you lead an insurrection against your own country and you can't concede defeat when you get defeated. That's a really dangerous thing. That's not something that that's not what our democracy is about.
Yeah. Let me ask you, do you think that there's a growing, you mentioned sort of like this last election was the first one that you can remember where everything was up for sale. I think another perspective would be it's always been up for sale. It just hasn't been so public. It hasn't been direct in the eyes of the people that like this is clearly my interest. Sure. You all know it, and I'm fighting for my interest. Here's the money. I don't care if people see me. Sit down in Mar-a-Lago, shake your hand, protect my interest. Whereas in the past, that doesn't happen on TV or with the cameras or on Twitter or on social media. That happened, but that still happens in those smoky rooms. So that's this, in a way, you're just describing politics.
There's a certain level of that to a certain extent that's very true, but it's on a much smaller scale.
Where do we go from here? If you're more
so
interested,
the good news is there's good news. The good news is that I truly believe America is too big to fail. And so the good news is that we've been exposed, we've been damaged. The U.S. dollar is damaged. There's lots of aspects of our of our bond market and our stock market that have been, this little escapade, this little exhibition of incompetent economics has cost us, 10, 12, 14 trillion dollars. But America's still too big to fail. And ultimately, America will prevail. And the stock market will rally back, and the bond market will rally back. The money's lost. It'll come back eventually, but it doesn't come back to the same people. And the people that get hurt are the small investors. The people that get hurt are the 401ks, that kind of thing. But the money will come back, and America will prevail. And we will, sooner than later be at the top of the food chain again, because that's just the way it works, because we are literally too big to fail.
Yeah.
Russia, just to give some perspective, Russia was not too big to fail. So when they failed, everything collapsed, right? And from the ruble to their stock market, to their bond market, to their corporate structure, everything collapsed. They're still around, but it might take them a decade or two to come back because they were not too big to fail. America's too big to fail. China is too big to fail. And so when China collapsed, they came back. When the U.S. does whatever it does, we won't even have the same kind of depth, I don't think, of failure that everybody else is, because, again, we are too big to fail. That's the good news.
I know you see the world through efficient market theory. I know you see the market as a discounting mechanism for its version of the economic future and fortunes of the U.S. economy and the global economy. I think what we are clearly, in my personal opinion, we're engaged of a war of attrition. If you cannot negotiate and make deals quickly with the countries you're engaged in, and even if you can make deals with most of them, if we are in a tit for tat with China, the longer that goes on, make no mistake about it, this is a war of attrition. Who can take the most pain? The U.S. side has demand on their side. In many ways, China has supply on their side, and both will use their strategic advantage against the other in a war of wills. I'm not here to ask you, what do you think the outcome is? But I think what I'm most curious about is when Tom Sosnoff looks at the price, when you look at vol, when you look at yields, what is the future that the market is discounting that you see? You look off into 9 months. Do you see economic pain? You see layoffs? Do you see, because when I look at the price and the volatility, the speed of this, I go, a bunch of people got handed pink slips and probably don't know it yet. That makes me, I have lots of concern about that. I have lots of issues with that. Does Tom Sosnoff see the market through the lens of saying, this is what price has done, this is what I'll expect in the future?
The only thing that concerns me is that I don't see how this is essentially. I don't see what we're going through right now. I don't see how this is good for business, because although American politics is isolated and we live in our own ecosystem, business is not. And large companies now, where would Apple be if they couldn't sell to other places around the world? Where would Oracle be? Where would Tasty be? Where are all these companies in the U.S.? What if it goes both ways? What if you said, hey, you know what? Our business, we would lose 30% overnight of all the business we do around the world. What about Apple? They'd probably lose 30, 40%. What about every single company? What about Amazon? What about everybody everywhere in the world? What if it goes both ways? So you're playing with fire here, and it's not the right approach. It's a old school dumbass approach from people that really don't understand business and negotiation. It is a serious lack of judgment and as I've said, it's all about intellectual laziness. They're not getting a clear view of the big picture. This whole America First thing is idiotic because, or the whole concept of make America great again is idiotic. When was America great? You know, I mean, just think about it. When was America great for you? When was America great for your parents? You know, I'm just saying, America, I believe in positive drift. So America always gets better and better. It's idiotic to think that America was great 50 years ago or 25 years ago. America's the best it's ever been in 2025. And it'll be better in 2030. There's no such thing as America was great in 1979, because I guarantee you it wasn't. I guarantee it wasn't great in 1987 or 1999. Like, it's better. It's the best we had then, but it keeps getting better every year. So the whole concept of make America great again is freaking idiotic, because it's always better in the future. It's never was better in the past. That's the whole beauty of everything. That's the reason you invest in the stock market. That's the reason you invest in any risk asset, is because things are going to be better in the future. And to isolate ourselves against the rest of the world, to think everything is going to happen here and we don't need to rely on global trade, globalization, decentralization, everything else, is freaking idiotic.
I don't disagree with that. I think my point of view has been, this has been about creating a multilateral coalition to then address trade imbalance with China. And I said with Chris the other day, one of the strategic errors I think was made off the bat is being so aggressive with Mexico and China. And the reason for the aggression, I think Trump cares more about getting the best price on every deal. I think he wants the midpoint on every deal. And maybe sometimes if you give up a little to the ally in the now, you win in the end, because you're able to establish sort of a multilateral coalition and then move, use that for foreign policy in your benefit. And I think potentially by wanting the best price on every single deal, you want fair value on every single deal, you take a more adversarial, combative approach. And that could be very short-term thinking. It's like stepping over dollars to pick up pennies a little bit in the world of foreign policy. Whereas the trader, we want the midpoint.
You're a sports fan. And there are GMs in every sport that can't make a deal. Like, there are certain GMs that make deals, and there are other GMs that can't make deals. Do you know why the GMs who can't make deals never make a deal?
Why?
Because they don't know how to, because they always need to think that they need to get the best of everybody else. They can't put together a fair deal, so they never make a deal because nobody will trade with them. Do you think there is any leader right now, any leader in the free world, who wants to do a deal with Trump? Do you think there's a single leader other than Putin? What do you think there's a single leader anywhere in the world that wants to do a deal with Trump? I would say no.
I get your point, but I think I'll give you an example here. I said this to you earlier on the network. I think there are many countries that have ideological differences with America, or ideological differences with China or Russia, but at the end of the day, business is business, and you put your ideology to the side, and you say our economy requires X. If that's American consumer demand, if that's Chinese supplies, if it's whatever it is, if you are a good leader and you're working on behalf of your country's best interest, I don't think the quality of the character of the counterparty matters more than the duty that you've been elected to represent your citizens.
I completely agree.
So I would say, to your question, I get the point, and I get where you're going, and I totally agree with the spirit. But literally, no, I don't agree. I think there are probably many that would and want to do a deal because they don't care about him, the man. They care about their citizens.
Well, they don't have to care about him, the man, because he's lame duck. And so you don't have to care about that because he'll be gone in 3 years. And if you do a deal, it hopefully lasts forever. But but I guess my point is you're not going to sit there because you don't believe in good faith. We don't do things in good faith anymore. America has gone from being the good faith engine of the world, we're the good faith center of the world, to being bad faith central. And that's a really scary thing. We've spent 100 years, Victor, trying to build good faith and be the protector of the world, be the supporter of the world. We're the richest country. Okay, we try to do everything. We are the richest country in the world. We try to do everything to help the rest of the world, and we have turned all that good faith into bad faith, and that is very tough to negotiate when you are viewed in bad faith. Now, are people going to look past this current administration? Of course they are, and everything will normalize over time. But you're talking about a market today that is, I mean, there's no question. You saw it yesterday. There's no question that the stock market, there's a ridiculous amount of cash on the sidelines. You saw it. We had a massive rally, and there's, we're probably on the precipice of another massive rally because there's an incredible amount of cash and everything seems like it's discounted from where it was. So that's why I don't worry that much in the end, but I think we should be concerned about the structure. We should be concerned about, the foundation. Did we just blow out a knee and are we going to come back as strong as we were before, or are we always going to be hurt going forward? That's the real question.
Yeah, I agree with that. Let me ask you, and I hope I'm not going all over the place, but I think this is still in the flow of the conversation. I had seen something the other day, Ray Dalio, and I'm going to bring up the point. I know you're not a huge fan, but I'm going to bring up the point that he made. His point, and he's been saying this for a while, he's pointed it out in a few of the books that he's made. His point was, in America, he said you have about 3 million people, or 1% of the population, and these are his words, not mine, okay? So I'm just framing it up. You got about 3 million people, 1% of the population who are incredibly brilliant. He said they go to the best schools, they come out, they create the unicorn companies. That creates value for about 10% of people around them who live, in the top 10% of America, and they live well. And then he said, you've got 60% of the U.S. population who reads at or below a 6th grade reading comprehension level. His point is we have a structural problem here in America. And the whole point, I thought, looking back of China joining the WTO in 2000, was that globalization was going to allow America to move up the value chain, and we were going to be able to do knowledge work. And I wonder, that promise, it's true, but it's true for too few. And maybe taxing wealthy billionaires, I'm going to say maybe, wealth tax is certainly a part of that answer. But there seems to be sort of a deeper structural problem as well, Tom, that we're paying 38% more than the OECD average of GDP per capita on education, but we're getting worse and worse educational outcomes. So maybe taxing wealthy people more will help get the money to go somewhere. But if we're already paying 40% above the average and we're getting these types of results, and by the way, I should state that survey, that statistic he's using, it comes from a survey. The number's actually 54%. That survey does reading levels, and they say it's not fair to convert that to 6th grade or 5th grade reading comprehension level. Just in case anyone's done the work and they want to put that out there, I want to do that as well. But the broader point remains, Tom, that what does Tom Sosnoff think about the fact that we were supposed to be moving up the value chain to knowledge work? And is that a reality for a big portion of the population here, Tom?
Sadly, I would agree with parts of that. I would agree with the general consensus that I think you're trying to say, are we getting our money's worth? And and the answer is we are not optimizing. We are not optimizing what should be a far better educational system. We're not optimizing it. There's a bunch of reasons for that. And because in the US, there's no priority. We have essentially eliminated a lot of the intellectual challenges and competition on almost every level. We've gone to everybody plays, everybody wins, everybody gets this, everybody goes to college. The competition there's been a lack of competition. There's been a lack of challenges. There's been a lack of changes to curriculum to make them, more interesting and to make them more valuable with all the changes that have taken place in technology and everything else. There's been a lack of language changes. There's a lack of diversity. I mean, we have a lot of issues. And we have the same issues we have the same issues in higher education. We've never changed the cost structure of higher education to reflect the different kinds of job opportunities. And so, we still have a one price fits all higher education system, whether it's private or public. And that should have been changed a long time ago. People that want jobs that are socially necessary but pay less should pay less to go to school than people that want to be an investment banker, for example. They should pay more than somebody that wants to be a social worker. And so I think that, we have the technology to support all this stuff today. We just haven't been able to deliver it or change, the current curriculums. The rest of the world is much more competitive with respect to their education. Have you seen like the videos of Chinese kindergarten kids?
Yeah. I mean, I've it's not just the videos, man. I've seen stuff like that in person, up close and in person.
It's crazy. You go to a kindergarten class in China or Singapore, and you go to one in in Omaha, Nebraska. It's not the same thing.
Mm-hmm.
And I'm not suggesting that it's that way or the highway at all. I'm just saying that our focus is on things that it probably we need to refocus some of our energies into making this country stronger at its core and stronger with its youth. And we don't have that. And we're sure not going to have that with eliminating the Department of Education and things like that. We're not going to have we're not going to have a regulated space. We're not going to have a universal policy. It's crazy.
Mm-hmm. Is there any room for your point of view where both of these things can be true? That if you've got holes in the boat and the solution is probably not to first go. I've argued this about the wealth tax solution as well. If you've got a bunch of holes in the boat and money is going to things that it seems doesn't make sense and the people don't have any say over it, that a uniparty is sort of driving us forward and just exploding our debt trajectory on things that don't really seem to make sense. That if you've got a bunch of holes in the boat, first you fix the holes in the boat. And that could be, people say whatever they will about Doge, but there's some aspect of that I think every administration has said that they wanted to do. I've seen speeches where Obama said he wanted to fix government inefficiencies. I've seen it where clearly Trump is doing the same thing. Biden has said the same thing. It's actually every administration that comes in says we're going to address wasteful spending within the government. And so there's some aspect of what's happening in Doge by trying to get the deficit as a percentage of GDP from 6-7% where it is now down to 3%. There's some aspect that I totally agree with, but then I I agree with you. You have to do that first. If you just go tax a bunch of money and it's going out of these holes to all these NGOs and nonprofit organizations that are benefiting from the government subsidies, but we're not actually addressing the homeless problem. We're not actually addressing the education problem. We're not actually building internet infrastructure for people. We're not building charging infrastructure for people. So on one end, it's like I see a lot of fighting about we should be doing this, we should be doing that. But not a lot of people saying both of these are problems.
I agree, but you're arbitrarily picking a bunch of just, you're picking some buzzwords and stuff. I mean, the idea that,
of course, because people will understand my reference.
I mean, I'm sorry that, some people think that cancer research isn't, isn't valuable, or education's not valuable. I mean, let's be fair, okay? Just because somebody gets fired doesn't mean that person was in a, there's lifelong people that have committed their life to this country, and it's ridiculous. I mean, we pushed it way beyond normal boundaries. It's not waste.
Okay, so you're saying, okay, I get what you're saying. That decreasing the government employees was too aggressive. That's what you're saying.
Because there's a certain amount of things that you have to maintain to, like, we're not going to cut all the color, all the life, all the culture out of and all the science, okay, and everything out of our world. It doesn't there's this. We're not a corporation. There's nothing that says we don't need to balance a budget every single year. We need to get better, but we don't. There's like the whole concept of having a deficit, like just the idea that people use this, they politicize the term. It's not that big a deal, okay? And you can reduce it, and it's been reduced before, and you do it through a solid economic plan. You do it through a combination of taxes, reduced spending, through solid economic policy, through deals that you make all over the world and everything like that. You don't just slice and dice and, no plan at all, helter skelter, throw spaghetti at the wall and hope it works. It's insane.
I agree with that. You need a plan. I definitely agree with that. Tom,
listen, Victor, if somebody could have articulated a plan, then I think people would have been okay with it. But nobody articulated a plan. You're asking a very smart consumer base of a lot of smart people, a lot of people that understand things. You're asking them to accept a non-articulated, nobody laid it out, nobody summarized it, nobody explained anything. They just sliced and diced, and it's just pure idiocy. Okay, that is not acceptable in America, especially from non-elected people. This is ridiculous.
I would agree with what you just said 100%. I think there's an aspect, whether or not, I think that the administration doesn't want, in many cases, on difficult issues, on things that aren't 80-20, I don't think they want to go out on a limb and have to wear a position. So the less articulation around messy issues, especially this navigating this trade negotiation without an articulated plan, without really going to the American people and sort of laying it out very clearly.
Let me ask you this.
Just to finish the point real quick, is that I think that creates the opportunity for massive chaos. When you don't articulate a plan as a leader, you get everybody running in different directions. And in a moment of high volatility, that is the moment at which you need the most cohesion. So instead of offering that cohesion and that solid plan, you play cards closer to the vest, which gives you maximum political flexibility, means you're sort of catering to your own political needs versus what the society needs, which is a clear, articulated plan. I agree with that 100%, that aspect.
I'll make it a very bold statement here, and I'd like to see somebody challenge me on it. I don't think Donald J. Trump has ever articulated a single plan that he has. I don't think he's ever articulated a single policy, never once, other than on a crazy like second grade level. Let's tax these guys because they're taxing us. I mean, really articulate a plan. He went to Wharton, articulate the damn plan. This isn't hard. And don't bullshit us. Just articulate the plan. I don't think he's ever articulated a single thing that he's ever done. And that's the scary thing. And people just accept it without articulation. They accept it without an intellectual argument, without an intellectual summary. They accept it just on the basis, oh, well, if he said it, it must be right. That's idiocy. We've never done that in the history of this country. I would like somebody to show me one example of one.
It's hard because you cut off the things that I could immediately explain, because you said not something like no taxes on tips, no taxes on Social Security. I mean, those are very straightforward policies, and I can give you a handful of those. I think meatier, more nuanced foreign policy takes, I don't know about that. Maybe I can go back to the Abraham Accords in some way, shape, or form. I don't know. I don't really care. Here's my thing.
I'll give you as much time as you need. Find one policy he's ever articulated in either his first 4 years or now. Never one ever.
It's a tricky thing, because I don't want to be put in the position where I'm constantly defending an administration. I don't want to be in that box.
I'm making a generalization. I'm making a broad statement. I did not come up with this. I have seen other people talk about it. Never once has anything ever been articulated. And you know what? That's freaking scary, because if you can't articulate it to the American public, then imagine what the message is to somebody else.
Yeah. I think part of that is we can't be honest about trade-offs. Like, a politician is unwilling to be honest about the trade-off of a policy. And every single policy, no matter what it is, there is no 100% win of a policy. There are some 80-20 issues, but a lot of the low-hanging fruit has been taken by every politician that's come before you. So the reality is, I'm elected leader today. You're going to end up with a bunch of things that have difficult trade-offs, and nobody wants to speak to those. Nobody wants to look the American people in the eye and say, look, this is a tough issue, and we're leaning this way. I defend why I'm leaning this way, and I understand that there will be people that disagree, and these are the trade-offs of this policy. Nobody wants to do that, especially in a social media world where people are only going to watch a 15 to 30-second clip, and they don't give a shit about political nuance. They just don't.
Great.
Tom, with the last 25 minutes or so, I kind of want to focus on opportunity a bit. We kind of focused on the problems. I don't know if we solved any. I think what I would like to say is I really appreciate the opportunity to have this platform, to have these discussions. I think a lot of people have really strong feelings right now, and asking difficult questions or trying to see a full range of potential outcomes and trying to be objective. I don't know if I am. People have said I'm biased one direction or the other. I think it's hard to do, and I appreciate the platform that allows me to even attempt to do it. I appreciate for you
First
having.
First of all, we want bias. I mean, who the hell? We're not an objective news network. We're not, I mean, this is our own thing. We want biases. We want opinions. We want to make this interesting. We don't give a damn about being objective. You can be whatever you want. I don't care.
I think from a trading perspective, regardless of the bias, you got to check it at the door. And now I'm curious, Tom, to turn to opportunity. Is this a really difficult market to short? But it does seem like if we're going to change the global flow of dollars, I don't know if we're through the pain yet. So I wonder what mental model Tom takes to dealing with the volatility that we'll see in the coming weeks and likely months, if not longer.
Well, you're right about this. You're right about that it's a very difficult market to short. And I think that if you were nervous about shorting this market, yesterday did not do anything to make you feel any less nervous, knowing that, that the market could rally 10% on a tweet. I talked about this with Dylan yesterday, and I think it's the thing that scares me the most about yesterday's market move is I don't like the fact that essentially in one day we've rendered much of the financial discussions and financial discourse useless, because now we all just sit around waiting for the next tweet. I mean, that is awfully scary to me. But I don't, I'm not somebody that shorts the market into weakness. I'm somebody that likes to short the market into strength. So, for me, to answer your question, that's not a burning question. I don't understand why people, at record highs aren't saying, how do you get short this market? When the market's sold off as much as it has, and we're down 20% or whatever it was, whatever it is, my question is not how do you get short? It's more of, how do you get long here? How do you get comfortably long, or how do you put a position on where you're wondering if it's too early to buy, or how much more downside is, that kind of thing. I'm much more interested in the long side than the short side, believe it or not. In spite of everything I've said, I'm more interested in the long side.
I agree. In that opportunity, does Tom Sosnoff have I am interested in getting technology. I'm interested in getting materials companies, steel and aluminum. I'm interested in getting, therapeutics company. Do you think that way, or you just go, whatever the market gave me today is what is interesting? If some stock is blown out by 15, 20%, that's what's on Tom Sosnoff's shopping list? Or are you going through this with some sort of intent that Mag 7 is something you wanted to be in, but you didn't get great pricing? Costco is something you wanted to be in, but you didn't get great pricing, and now you're sort of applying that in this market? Or you're just taking what the market gives you?
Totally just taking what the market gives me. I mean, when it comes to trading, I'm very much agnostic with respect to underlying, with respect to strategy. I really am. I don't look at this as, oh man, I think there's a reason to be long Coinbase here versus Apple, or, Tesla versus Reddit, or whatever it is. I look at this market and just think, based on price, this is an interesting stock to me. That's it.
Mm-hmm. What do you think about Bitcoin here? It's kind of hanging in around 80,000. It's been in a fairly tight range of 80 to 90. You can make a case, as some in this chat have, that when people talk about the recent stock volatility, they're saying Bitcoin has been less volatile than it usually is relative to stock market volatility. But then others in this chat and that watch this program have said, yeah, but they're clipping what happened at the beginning of the year. If you take Bitcoin from high to low, you've got, a 20, 30% drawdown, and you just got it in Bitcoin first, in the high beta riskier asset. They liquidated that first before you saw them move down the risk curve. You're more than welcome to opine on that. My base level question is, how do you think about Bitcoin in a world of heightened volatility?
Well, the most interesting part of the question is, in a world of heightened volatility, Bitcoin becomes somewhat irrelevant, because the volatility of Bitcoin right now is lower than the volatility of volatility.
Correct.
So when I look at different underlyings right now, I might look at, just as an example, Tesla has a higher volatility than Bitcoin. Apple has almost the same volatility as Bitcoin. I don't necessarily, when I look at Bitcoin, I see Apple. When I look at Bitcoin, I see Nvidia, or I see Tesla, or I see Reddit. I'm not looking at these underlyings, and I'm not looking at Bitcoin any different. Before, it was interesting to me, because when Bitcoin had a volatility of 100 and the S&Ps had a volatility of 20 or 15, then I looked at Bitcoin as having this, 5 or 6 times the expected move of the stock market, or of any of those stocks. And so if you want to talk about a little asymmetric upside, that was the attractive thing about Bitcoin and ETH. Bitcoin and ETH are very stable here. And I look at the marketplace and I say, if you want asymmetric upside, you should buy NVIDIA. I mean, Apple was up $30 from high to low yesterday. Like Bitcoin doesn't move 30% in a day, but Apple does now. Bitcoin doesn't even move. Like, what was the move in Bitcoin today? A few, maybe a few thousand, 3%. Let's just call it 3%. Yeah. But the move in Apple today was 5%. So Bitcoin has essentially been rendered, just another trading vehicle right here. It's not very interesting. I mean, ETH doesn't even move. I'm not interested right now.
I agree with that. But then do you think that the whole store of value thing, you think the whole store of value conversation about Bitcoin, that's what will end up happening in a few weeks or months, and it's already evolving. People are talking, before it was the inflation hedge, then it was the money printing hedge. It is, MicroStrategy and what they do with corporate treasury becomes interesting. And now the interesting part is just the relative store of value within a world of high volatility. Is there any part of Tom Sosnoff that's interested in that particular point?
No, I mean, this should be, if you're a MicroStrategy investor, this should be your biggest fear, because the only reason you would buy MicroStrategies is because you had this insane upside of this like little Ponzi scheme they created. Like right now, MicroStrategies is, to me, I wouldn't touch it with your money. Coinbase, more interesting than MicroStrategies, but still not that interesting to me. But you know what? I used to have a lot of respect for Brian Armstrong and the whole Coinbase, essentially their business, but they're getting what they deserve right now, because they've suffered a 50% haircut, and they deserve it, because this is what happens when you essentially don't play by the rules. And so or you enable certain things to happen. So I'm still incredibly bullish on digital assets. I'm incredibly bullish on, like the conversion. I think everybody's going to have a digital wallet within a couple of years. I think everybody's going to be using stable coins for lots of different things. Just, convenience, simplicity. I think there's no question within the next year, we're going to be tokenizing different equities. I don't think it's avoidable, and I think under the current administration, it's not even going to be a regulatory challenge. So I think tokenization is right around the corner. And I'm not opposed to it. So tokenization, stable coins, much more minting stuff on the blockchain, many more digital assets potentially, and digital asset technology. I think that's all going to be intertwined with everything else we do. So in that sense, I'm very bullish on the space. I'm less bullish on Bitcoin and ETH, as trading vehicles. They still haven't become real trading vehicles. And that's really weird to me.
There is some part of me that wonders, Tom, if this ends where it typically ends, right? Where if this ends with we've triggered something within the plumbing of the U.S. economic system, if not now, that we could potentially get to that point with enough volatility and enough stress in an economic system, especially one that's over leveraged and indebted, that at the end of this, we end up sort of needing stimulation again. And then what would that mean for risk assets? What would that mean for things like Bitcoin? I'm not saying it's going to happen. I don't like to try to predict it, but there is a part of me that keeps it in the back of my mind that whenever we've gotten into these situations in the past, as long as I've been an investor, it has ended one direction. A lot of fear, but that fear, that deflationary force, ends up triggering a Fed response that leans us back in the other direction. And that tug of war between the deflationary forces at work right now and the potential inflationary responses, to me, I think that's a really difficult roadmap to navigate. Let me ask you to react.
What are you saying? I don't understand what that means. Like, what are you saying?
Meaning, here's what people.
Happens.
Yeah, here's what people want to do. When vol gets high, what they want to do is, a lot of people, the natural reflex, unless you've been doing this for a while, the natural reflex is to say, I want to go to cash. I want to be safe. Okay. And we could be in a situation where, given the tariffs, given higher unemployment that could be on the horizon, given a lockup in potential financial plumbing, take your pick or add them all together. And if that happens, you end up needing a fiscal and monetary response. And if that comes sitting in cash, you get murdered because you're getting effectively a devaluation of currency. So your safety, your implied safety, ends up being a thing that leaves you behind as risk assets take off on a fiscal or monetary response. So I'm saying navigating that left distribution and the right distribution as the curve gets wider, it's really difficult. And the knee-jerk reactions want to get safe, but you gotta look at what has always happened in that situation in the past. That's all I'm saying. So as ugly as you think it's going to get, there's an equal and opposite force that has always come after it gets ugly.
Okay, accepted.
I want you to, if you could, respond to some more. I had you respond to Ray Dalio earlier, and this is one of my favorite things to do is bring, these big quotes to you and watch what you do with them.
I love Ray Dalio quotes. He drives me nuts. Go ahead.
Okay, so Bill Gross on Twitter, I believe this is Bill Gross, says,
Bill Gross? Did you say Bill Gross?
Yes.
Oh, gosh.
You're especially going to like this one, but I think it's important that you respond to it.
I didn't even know he was still alive. Go ahead. I thought he stole enough money and then disappeared. But go ahead.
This market, quote unquote, crash will affect millennial and Gen Z investors for long to come. What before was a can't-miss way to make money will induce caution and more conservative attitudes, resulting in lower PE ratios, higher yields, and low single-digit returns. Your thoughts on that quote by Bill Gross?
He's playing. So I have two thoughts on this. I'll do really quick. One is the quote is essentially, it's a master of the obvious quote. And I mean, I think that anybody that looks at what's happening now could say the exact same thing, because that's, again, master of the obvious. I look at this kind of situation right now, similar to how I looked at other events through U.S. stock market and economic history. And every time, like, you could have said the same exact thing in 2009. Like, you could have said it was 100 times worse, actually, in 2008, 2009. You could have said the same thing in 2000, 2001. And my response to that is, we always come back bigger, better, stronger, and with more opportunity. What we're doing right now that Bill Gross is missing is we are just winding everything a little bit tighter, which will create even more opportunity. Whether or not, that changes expectations and stuff like that. Speculation has been around for hundreds of years, and it's not going anywhere. And what this kind of move does, is it introduces more people into the world of finance. It doesn't, short term, it knocks a bunch of people out. Long term, it introduces a lot more people via the opportunity. I think Bill Gross is being a little bit short-sighted there, and it's a public statement.
I started in finance January 22nd of 2007, wearing a cream-colored button-up shirt with a yellow and brown striped sweater vest. I remember it like it was yesterday. It was 18 years ago, Tom. And within a few months, I was in the center of a global financial crisis. And somehow 18 years later, after financial crisis, disinflation, deflation, inflation, geopolitical instability, wars, currency crisis, this is still to me, it's an incredible game, and it is one of the few places where the bullshit and the spin, it doesn't fly. You can look at a price and you can figure out what trillions of dollars believe is the real truth. And I appreciate that honesty about the market. I have very little emotions. I don't know what happened to me as a kid. Maybe I wasn't shown enough love, but I just don't have a lot of emotion. So the ability to look at a place that doesn't give a shit about my feelings about the matter, it just gives me what it thinks about the reality, is something that I love. And I can't imagine a world where I didn't get to participate in risk exchange. So I would ask you, Tom, you're one of the reasons why I had the opportunity to be in that world for so long. You introduced these concepts to me as a young kid, 20 and 21 years old. I would ask you to look out there and talk to two different people. Talk to the 30 and under crowd about what this volatility on their screen means for them and how they should think about that on a long-term view. And talk to the 55 and older crowd that's in retirement and is looking at this volatility on their screen. I think if you could start with anyone you want, actually, but two different crowds, the 30 and unders and the 55 and overs.
I will. I'll get to that. I just want to say one thing, because I think that this kind of is interesting. I traded in the 1987 crash. I was 30 years old. And the day we crashed, we weren't sure if we could get our money out of the clearing firm. We weren't sure if, all my money was, I didn't know if my money was gone, whatever. I had no idea. And we were 100% convinced, every single guy on the trading floor was convinced that the world as we knew it, like the whole business of trading, was over. Like, it was over, literally over. Not another customer would ever make a trade because everybody was blown out. Customers, market makers, all the money was gone, that the whole business was over. Like, the whole concept of trading, investing, everything's done. Market crash, all done. Next day, we're all back like nothing ever happened. I mean, and we were convinced on the day of the crash, that Monday, Black Monday. And then Tuesday, and by Wednesday, everything's back to normal. People are winging it again. That's why the Bill Gross comment, it's not going to fly. Now, to the young person and to the older person, I don't care whether I would say the same thing to a 23-year-old, 25-year-old, or a 55-year-old. I was writing a talk tonight before this segment because I'm giving a talk to a bunch of high schoolers in an entrepreneurial program outside of Chicago. And so I was writing my talk. I'm giving them the same talk I would give to 35-year-olds, like, it's not, I'm not tailoring it in that sense. There's never ever since I've been in this business, which is since the early 80s, and we've gone through some incredible dark periods, 2008, 2009, 2000 to 2002, 1987, 1989, 2020, 2022, 2025, 2018, all these times, incredibly difficult times in the world and whatever. There's always an extraordinary amount of opportunity. And I've always found the best time, we built Thinkorswim when the market was crashing in 2000. You remember that? We built it when literally the market was crashing. We started in the summer of 1999, and in 2000 we were crashing. And in 2001, when we were launching the product, the whole world was crashing. The NASDAQ was down 80%. And we didn't give a crap. We're like, I don't give a damn. Everybody wanted to trade. When we built Tasty in 2010, 2011, it was right after the flash crash. There was a global financial crisis. Everything was in meltdown stage. Everybody was panicking. And we just calmly rolled out Tasty and said, you know what? I don't give a crap what's happening in the rest of the world. Everybody wants to hear this stuff. So you can't let yourself be influenced by things that you have no control over. Just worry about the things that you can control, and and there's always opportunity out there. That is the most amazing thing about America. That's the most amazing thing about this country is there's always opportunity. I don't want that to go away, Victor. That's the only thing that scares me. I don't want to blow. I don't want us to kind of blow that dynamic.
Beautifully said, my friend. We are coming up on time. Tom, I told you I'd take every bit of the 90 minutes, and I really appreciate you, giving us the time and the perspective. I would tell everyone out there before we, take the show out here, if you haven't subscribed to the channel, make sure you do so. There's a secondary channel, Tasty Live Trending. Make sure you're subscribed to that channel as well. Head to tastylive.com. Make sure you check out a couple of the blogs that are there, as well as some of the learning resources. In particular, Tom writes a Cherry Bomb Note every Sunday evening where he likes to stir the pot and go against the grain. I would recommend that for sure. Tom, it's been an honor and a pleasure. Thanks for coming on and doing this, my friend.
Thank you. Thanks so much, Vic. That was great. Appreciate it.
All right. Everybody out there, hit the like button before you get out of here. If you enjoyed the conversation, share the video with a friend. Share it out on your social media with a link to the timestamp where this starts. We'll see you back here tomorrow. I'm sorry, this is our Synthetic Friday for the show. We'll see you back here Monday. Same time, same place, same great network, only on Tasty Live. Until then, peace.